And esteemed colleagues, a very warm welcome on behalf of the entire team at CNBC-TV18 to the second edition of the CNBC-TV18 Banking Transformation Summit presented by Nucleus Software. They have been partners with us in this endeavor, and once again, many thanks to them for being on this journey with us. It is truly an honor to be here with the entire banking ecosystems and the powers that be at India's financial sector. Our banking stalwarts, our innovative fintech leaders, our dynamic NBFCs, our regulators and policymakers, and of course CEOs of India's largest banks are all here with us to chart out the action agenda for India's banking sector and its future. Now, a little over a decade ago, ladies and gentlemen, it would have been hard to imagine the current vibrancy and vitality of India's banking sector. Back then, it seemed that we would not escape the specters of costly capital and rising non-performing assets. But times have changed, and how? Since then, NPAs have declined from a peak of 18% to 4%, and the network of private bank branches have expanded by 60% to now more than twice the number of bank branches in America, helping 520 million people open basic bank accounts and join the financial mainstream. It is, in fact, 10 years of the Jan Dhan program. Banks and financial institutions have transformed India's masses into savers, providers of capital, and in ever-growing numbers, even entrepreneurs, I dare say. But what might seem like peak performance, ladies and gentlemen, is just the initial acceleration setting us on course for the long race ahead, and it is going to be a long and arduous one. For perspective, despite a record-breaking year for consumer credit growth, it still measures only 37% of GDP when compared with 62% in China and 80% in the US. Corporate banking still struggles to provide companies the affordable long-term debt that the country needs for big capital investments. Clearly, there is a lot of ground to cover, and of course, with technology shifts, there is an opportunity as well. And today, we stand at a pivotal moment in India's journey with a vision to become a $10 trillion economy and a developed nation by 2047. The role of India's financial sector has never been as critical as it is today. It is, in fact, the lifeblood that will drive us towards that ambitious goal, ensuring that growth is inclusive, sustainable, and far-reaching. India's banks will need blistering pace to run the course even as they face headwinds from tighter capital requirements, the rise of alternative investment avenues, and concerns about the asset quality of unsecured loans. The prize that awaits is a chance to leverage the Bharat opportunity and become the stimulus of India's ambitious goal of achieving that $10 trillion economy milestone. Now, in this scenario, ladies and gentlemen, the theme of the second Banking Transformation Summit is aptly titled Bharat's Banking Roadmap for the Future. It's dedicated to helping banks and businesses navigate the opportunities and challenges that dot the financial landscape of India's dynamic heartland. It is essential that we build a financial system that is not only robust but also compassionate, one that reaches the bottom of the pyramid, empowering every citizen, especially those who have historically been marginalized. We must ensure that access to capital is no longer a privilege but a right, that it is affordable and available to all, from small business owners in a remote village to an entrepreneur in a bustling metropolis. Illustrious leaders of India's financial sector will join us on this stage to share their vision of an empowered banking sector catering to a nation of equal opportunities. I would like to extend our gratitude and thank our chief guest for this evening, Mr. J. Swaminathan, the Deputy Governor of the Reserve Bank of India. Ladies and gentlemen, a big round of applause for the RBI Deputy Governor, sir. Thank you very much for joining us this evening. It truly means a lot to us to have you here with us, and we look forward to hearing from you. I'd also like to extend my gratitude to our guest of honor for this evening, Mr. B. Anantha Nageshwaran, the Chief Economic Advisor of the Government of India. He will join us in a short while from now. He was supposed to be here, but we've got a GDP print coming out in just a couple of moments from now, so he will join us virtually and deliver the good news to us here as he joins in on the discussion. We will, of course, have many leaders talk to us about how they see India's banking sector change and evolve, what they intend to prioritize, how capital must be put to the best use. All of those will be conversations that will happen right here with the very best in India's banking system. So ladies and gentlemen, once again, many, many thanks for joining us here on this very special edition of CNBC-TV18's Banking Transformation Summit. It is a particularly proud moment for all of us at CNBC-TV18 as we enter our 25th year. We will turn 25 in December, and it has been a path-breaking journey for many of us, and I'm proud to say that we've continued to not just lead, but we've done it with impeccable quality, and we've done it with trust that we have ensured that we create with our viewers. So once again, many, many thanks for joining us here this evening. We look forward to the conversations. Do join us online and share your comments, your thoughts, and your suggestions with us. Once again, ladies and gentlemen, thank you very, very much for joining us here this evening.
Thank you, Shireen, for those opening remarks. And now, ladies and gentlemen, we are joined by a visionary leader who has been at the forefront of India's monetary and financial regulatory landscape. With a distinguished career spanning over decades in the banking sector, he has played a pivotal role in shaping the country's banking policies, ensuring financial stability and driving innovation within the sector. His contributions have been instrumental in strengthening India's economic foundation, fostering resilience, and promoting sustainable growth. Please join me in welcoming J. Swaminathan, Deputy Governor, Reserve Bank of India, for his keynote address.
Sri Anant Nageshwaran, Chief Economic Advisor. I'm told he will be joining very shortly. And Shireen Ban, Managing Editor, Lata, the Executive Editor, CNBC TV18, the Managing Directors and CEOs of the banking fraternity and the NBFC, the leadership from the Fintech sector, distinguished guests, ladies and gentlemen, good evening to all of you. I'm indeed delighted to be present here amongst you today to speak to you about the evolving banking landscape and the imperative need to build and sustain financial sector resilience if India is to achieve her aspirations of becoming a developed nation or developed economy by 2047. In a developing economy like India, where private capital sources are limited, it is the banking system-led financing model that comes to drive capital expenditure. The financial institutions, therefore, must maintain a sound financial position and strong balance sheets to support significant investments in infrastructure, industry and innovation to fuel India's economic growth. Thankfully, the financial health of both the corporates and financial institutions is at its strongest level in decades. However, for sustaining this financial stability, the sector must prioritize financial and operational resilience alongside strong corporate governance. Further, banks and financial institutions need to strengthen their internal defense mechanisms, namely the assurance functions, cultivating a culture of compliance and fair play to ensure they retain the regulators and, more importantly, the customers' trust at all times. So I would like to now dwell upon in this part, as a regulator, how we have been playing a role of an enabler. Maybe in three small points I will highlight that, and towards ensuring as well as preserving the financial system stability, the Reserve Bank has been taking many definitive steps. Today, I would like to walk you all through a few of those enabling steps by the Reserve Bank. Number one is a consultative approach to regulations. Globally, and especially in India, regulatory approaches have evolved to become more consultative, incorporating the feedback to develop balanced and effective regulations. The establishment of Regulations Review Authority 2.0 in 2021 is a testament to RBI's commitment to streamline regulatory instructions, reduce compliance burden, and eliminate obsolete requirements. thus fostering a more efficient regulatory environment. Having served as the chair of the advisory group representing the industry at that time, I can personally attest to the regulators' responsiveness and sensitivity of the industry's concerns. The implementation of various recommendations of RRA 2.0, coupled with the tireless efforts of the various interdepartmental groups within Reserve Bank of India, has already led to the issuance of several harmonized, consolidated and updated master directions, as well as withdrawal of over 1,000 circulars, apart from doing away with many regulatory and supervisory returns that have become redundant. These measures have significantly reduced the compliance burden on the regulated entities. The second is pushing for a good governance. History is replete with examples, both in India and abroad, as to how apparently successful business ventures quickly folded up due to poor governance and excessive greed. Therefore, the Reserve Bank has taken up this as one of its focus areas to create awareness as well as to ensure adherence to good corporate governance practices. We are having more frequent and direct engagement with boards and top management of regulated entities as well as self-regulatory organizations. Through these dialogues, we share our concerns and priorities and also strive to understand the challenges faced by the industry so that the appropriate regulatory measures can be taken up. The third is instilling a culture of compliance. An essential element for sustaining longevity of financial institutions is that a culture of compliance should prevail across the institution. The recent direct engagement with the heads of assurance functions as well as CFOs and auditors by Reserve Bank is testimony to our efforts to strengthen the internal defense mechanisms within our financial institutions. The independence and professional conduct of assurance functionaries, strongly backed by the board and top management, is essential to preserve this culture. I am glad to share with you that these initiatives have been very well received, and I would like to thank the heads of our financial institutions for prioritizing these initiatives in their organizations. So having spent some time on how we have played an enabling role, I would like to shift to highlight how industry is cyclical, including finance. The financial industry, like any other sector, experiences cycles, and it is currently riding a high wave, as all of you would agree. Therefore, this is the right time to strengthen our institutions, enhancing their financial and operational resilience, and ensuring the long-term stability of our financial system. For those wondering why now, I emphasize that taking decisive action now, even if it means swallowing some bitter pills, is crucial to ensuring our financial institutions remain strong enough to support the national goal of becoming a developed economy by 2047. It's not only important to simplify, harmonize, and rationalize or modernize, but also to strengthen the regulatory and supervisory framework. Recent drafts on expected credit loss, project finance, and liquidity coverage ratio exemplify this approach, aiming to reflect the needs of the industry while seeking to step up financial strength and stability. And the third part of my speech I thought I would cover as to how RBI has been in the forefront of innovation. RBI has undertaken several initiatives to support the development of digital public infrastructure and establish robust institutional frameworks complemented by various policy measures aimed at enhancing the financial sector. In 2019, the RBI introduced the regulatory sandbox framework to provide a controlled environment for testing new financial products, services, or business models with real customers under the regulatory oversight. This initiative facilitates collaboration among regulators, innovators, and financial service providers to assess the benefits and risks of emerging technologies. Since its inception, 5 cohorts of the sandbox have evaluated various ideas, with some of them proving to be feasible. to address situations where a product or service might fall under multiple financial sector regulators. An interoperable regulatory sandbox mechanism was also introduced in 2022. Complementing these efforts, the RBI has also organized global hackathons under the Harbinger initiative, which not only rewards winners generously but also provides stipends to shortlisted teams to support the prototyping of their solutions. The third edition, Harbinger 2024, themed Innovation for Transformation, invites solutions aimed at achieving zero financial frauds and creating Divyang-friendly technologies. In 2021, RBI established the Reserve Bank Innovation Hub, which has been instrumental in advancing digital solutions, such as fully digital and streamlined delivery of Kisan Credit Card farm loans. Last year, it launched the pilot on public tech platform, now more famously renamed as ULI, designed to facilitate frictionless credit by enabling seamless flow of digital information to all lenders. This platform features an open architecture and open application programming interface, allowing financial sector participants in a plug-and-play model. So the fourth part of my speech is I thought I would take to some of the commentaries that we hear. Having covered extensively on some of the initiatives that showcases Reserve Bank as an enabler, I now would like to deal with some commentary of regulatory disruption that plays out in the market, thankfully only by a few, but it is still necessary for us to examine this. One such narrative is that the regulator's actions may curb innovation or intrude excessively into business operations. There is also a feeling that regulators must be more supportive of risk-taking. What needs to be understood is that while businesses can be adventurous and inclined to take on greater risks in pursuit of their goals, their profits, and investor returns, the regulators have the responsibility to protect depositor and customer interest and preserve the financial stability. The role of the regulator is to establish guardrails or a balanced framework that encourages innovation while ensuring that risks are managed prudently. For example, the Fintech platforms often provide customers with a seamless, efficient experience. By leveraging digital public infrastructure, these platforms can reach a wider customer base, including those who previously had limited access to financial services, thereby advancing financial inclusion and empowering the underserved communities. They help in reducing the cost of customer acquisition as well as transaction cost. Digitalization also allows banks and NBFCs to leverage data for greater insights into their customers' requirements and behavior, which can be used for developing bespoke products, apart from facilitating better risk management and compliance. Reserve Bank has been playing an encouraging role all through such initiatives. However, this digital shift also introduces risks that must be properly identified, mitigated, and managed to maintain a stable and secure financial ecosystem. The integration of disparate entities delivering a digital product often results in complex structures with overlapping responsibilities. In many instances, the actual lender may not even be visible to the borrower, despite regulatory requirements for full transparency. While fintech platforms drive innovation and revenues, credit and operational risks, along with consequent losses, if any, still primarily rest with the regulated lenders who collaborate with these platforms. This can create a disconnect between the service providers and those bearing the risks, leading to potential vulnerabilities for the individual lenders as well as to the financial system. For instance, while loan sanctioning and disbursement have become increasingly digital, effective collection and recovery still require a feet on street and an empathetic approach. Many fintech platforms operate on a business model that involves extending small value loans to customers, oftentimes with poor credit profiles. Unfortunately, this is often followed by aggressive recovery tactics such as invading customers' privacy by accessing their contacts and personal data. These practices can seriously damage the reputation of the regulated lenders associated with these platforms. According to RBI regulations on outsourcing, even though a regulated entity may rely on third parties to perform certain activities, it remains ultimately accountable for the actions of its outsourced agents. Another narrative I would like to address today is the perception that supervisors are overly eager to impose business restrictions, sometimes being portrayed as trigger-happy. This misconception creates an impression that regulators are constantly looking for opportunities to clamp down on financial entities. We are sometimes asked by the media, some of them who are here, who is next, implying that supervisory actions are routine in nature. In reality, the decision to impose business restrictions is never taken easily. Strong supervisory actions are brought in only after careful on-site examinations, off-site data analysis, and extensive engagement with the regulated entities concerned for remediation, oftentimes stretching into several months. Our primary goal is to ensure the stability and integrity of the financial system and not to hinder business operations. Out of over 150 banks, over 9,000 non-banking financial companies, about 1,500 UCBs, and various other entities that we supervise, stringent actions have been taken only in a handful of cases. That too, the most outlier in each category has been called out for such punitive actions so that it has a demonstrative effect on the rest of the industry. These measures are not about penalizing, but rather about protecting the interests of depositors, customers, and the broader financial system. Despite these efforts, it's disheartening at times to see innovative misinterpretation or intelligent interpretation of regulations. A recent case in point is that of peer-to-peer, the P2B lending regulations. The regulations as originally conceived, I'm sure some of you here would certainly know, the regulations as originally conceived envisage the platforms to function like online marketplaces connecting lenders with borrowers, with no credit risk borne by the platform and no commingling or retention of funds by them. However, the supervisory findings over the last 1 year revealed that some of these platforms adopted practices which were violative of both letter and spirit of the regulations. Instructions issued earlier this month on P2P lenders are nothing new, but are merely responding to the egregious violations observed in some cases. However, it is being presented in some quarters as if these new regulations will kill the industry. On the contrary, the differentiated licensing and light touch regulations that were granted to such entities are intended to help them set up a unique platform and not mimic banks and NBFCs that are more robustly capitalized and more stringently regulated. So in conclusion, despite occasional brickbats, the regulatory frameworks have been adopting a consultative approach which has helped shape a resilient financial sector. Over the past few decades, the Indian banking sector has navigated many challenges, including the Asian financial crisis, the global financial crisis, and most recently the COVID-19 pandemic. Each time, the Indian financial sector has emerged stronger, about which we are all very proud of, thanks not only to the efforts and the adaptability of the industry, but also to the prudence and foresight of the regulatory framework. All of us are partners in this journey towards realizing the vision of Bharat 2047. However, dreams cannot be built on weak foundations, which is why it is the regulator's responsibility to set up both enablers as well as guardrails that will ensure that we reach our destination safely, securely, and keep going. Rather than viewing regulators as disruptors, I would urge industry to see the regulator as a partner towards a stable and prosperous financial ecosystem. It is therefore essential to appreciate the intent behind the regulations, which are designed to protect customers, ensure fairness, and maintain stability. Let us channel our creativity into innovating products and services that not only comply with regulations, but also enhance the overall health and inclusivity of the financial system. Let us focus on developing solutions that add genuine value rather than seeking ways to bypass the rules or to do more of the same. By aligning innovations with regulatory objectives, we can build a stronger, more trustworthy financial sector that benefits everyone. With this, I thank the audience for the patient listening and CNBC-TV18 for inviting me to this summit and giving me an opportunity to address you all today. Thank you.
Thank you so much, Mr. Swaminathan, for that enlightening speech. I would request you to kindly stay back on stage and to take the conversation on transforming financial landscapes, building resilience for economic stability forward. I would like to invite Lata Venkatesh, Executive Editor, CNBC-TV18. Lata, over to you.
Thank you very much, Mr. Swaminathan, for giving us this overarching picture and where the banking sector and the regulator wants the banking sector to head. I must tell you that you spoke of brickbats. I've not heard of so many. When we ask bankers and NBFCs for any reaction to the Reserve Bank, it's usually very, very cordial and positive. Of course, they check with us, is it on the record or off the record? So, the response also depends on that. But I must say, jokes apart, that the fact that, the first point you made, that, unintrusive supervision, removing outdated regulations and filings, that's something that's come in for very high praise. I mean, there are people who say that all the Reserve Bank asks us now is, just give us your login and we will check whether the processes are there. Extremely, that's come in for a lot of praise. I'm going to wear my journalist hat and ask you questions, which were not covered. One of the big talking points, of course, is that, deposits are becoming very, very hard to come by. You've been a commercial banker, now a central banker. What's your view? Is this structural? Because if you take if you ask people under 40 over here, I don't think any of them even have an FD. So has something structurally changed about deposits?
Yeah, thank you, Lata, for having me here. It's a pleasure to be participating in this event. It's a good question to start with. You said deposits are hard to come by. Maybe I would like to slightly put it differently, because if you look at the numbers on a year-on-year basis, deposits are still growing at about 11-12%. It's not that that there is a contraction or there is a degrowth. Deposits are still coming at about 11-12%.
They're growing slower than loans.
Yeah.
That's it.
So the only context, as you rightly said, is when seen in the context of the rate of growth of credit, it seemed to be not keeping pace. So that's the context in which the discussion comes up. What we need to also see is that these are cyclical, and we have seen times in which the deposits grew almost twice as that of credit. We had a couple of years of that nature as well. We had 8-9 quarters when deposit was outpacing and banks were had to find ways to manage the liquidity that was flowing in. And today you have a situation where the demand for credit is more, and aided by digital lending, the money has become mobile. So the growth is going good. But coming to the second part of your question, is structurally something different. But I think this is something which we'll have to understand, that this is a generational shift.
Yes.
Today, the younger generation have more options and are also willing to take a bit of a risk in terms of variety as well as chasing better returns. So deposits becoming a choice of senior citizen is not something which we should be surprised of. This is a part of the evolution. So whether it is debt funds or equity funds or index funds or investing in properties or gold, there are multiple options for financial savings today. And this will be typically cyclical, and I'm sure that people will find the best way to manage their savings. Okay. So as long as that savings do take place in some form or the other, we should not be much worried. And one last line, again, to deal with the structural part. As a regulator, what we have done is, in the last couple of MPC statements, we have just sensitized the lenders that if this gap is allowed to continue for longer, it may create a structural liquidity risk for some of the banks or financial entities who are already in a high CD ratio. That's the part, and I'm sure that they are competent enough to see what is emerging in front of them and let them handle.
Okay, then that's the follow-up. You have, like you said, in the past, two policies warned, or rather mentioned, highlighted that credit deposit cannot have such a gap. Are you satisfied with the progress?
See, there is no golden number or an ideal number that we can chase in these matters. So whether we are satisfied or not satisfied is difficult to respond to.
Trend.
But if you look at the trend, you are right. The incremental CD ratio is certainly moderated. That is one part. And we are also seeing the deposits are also growing, and we've seen banks augmenting their product offerings. Banks are also talking about improving their service quality so that they place themselves as a choice to the generation which would like to explore various options.
So you don't see yourself taking any steps to encourage? You think that the trend is already in the right
Absolutely
direction?
no steps required at this point in time in our view, because we have told the boards to strategize, recalibrate, basis their scale and complexity. So it is left to the commercial wisdom of the entities rather than a regulatory prescription.
You know, this understanding that youngsters are saving through capital markets and not through FDs, many public finance economists point out that anyway, even the capital market money is in the banking system. So, what exactly has changed in that case? Instead of FD, it is in current account, is it?
Yeah, I don't think anything has changed, because money will finally have to find its place. It will be back in the banking. If not in retail deposits, it could be in deposits that comes through the markets. So that way the money has the same velocity, and it has got to move within the corridor which is allowed unless money is remitted abroad.
Yes.
Other than that, I'm sure that
that
the money...
leaks
So the economists,
out.
what they are saying is fine. I think when you have two economists, you will have three opinions. So I think I'm not competent to make a fourth opinion on that.
Okay. No, the reason why I'm asking you is that if the money is going only as current account, from FD, it's a larger part of the money probably is going as current account. Would you, a part of the reason why the slowness has come is, slowness in deposits has come, is probably because the Reserve Bank created less reserve money in the previous year, for the simple reason that at that time you all were chasing inflation. So do you think it is cyclical? Do you think it's a matter of time? And if it is a matter of time, by when do you think loans will, go below deposits or deposits?
I think so. I'm not I'm not in a position to respond to that particular analogy. Maybe you reserve this question for the MPC.
Okay, then the other thing that you raised even in your speech, the markets, the financial sector is in a high point. But in this high point, you have been pointing out that unsecured loans are a matter of worry for you. MFIs are a matter of worry for you. How much has the worry abated, or do you think it is still a matter of worry?
Again, I would like to be categorically clear that whatever financial parameters that we are tracking, at this point in time, certainly there is no worry or a concern, because if you look at the slippages, if you look at the credit cards, if you look at the GNPA, NNPA, or the SMA, as we call it, whether it is 30 plus DPD or 60 plus DPD, none of these numbers are showing any trend that is likely to become a worry or concern. They all seem to be behaving fine. But if you compare them with the situation a year ago, probably there is a slight uptick. Anticipating this, we took some preemptive measures already, as you would know, in November last year. We saw certain outlier growth in certain segments where we thought there could be a possible risk build-up. On those segments, we called out and added certain risk weight, which was a very clear signaling device. And if you look at the last 2-3 quarters, those segments are moderated. So I think that the measure that was taken, which was preemptive, has had its effect. So we see a moderation at this point in time. And as regards the little bit uptick that we see in some of these parameters, while it is not yet a matter of concern, again in the last MPC statement, if you would recall, we have requested the lenders to strengthen their underwriting standards and also step up on their collection and recovery process so that we don't end up in a situation where there are elevated risks. I think that must be good enough.
Would you say we have peaked in terms of the high and now we should be prepared for the financial high cycle to start down cycling a bit?
No, but I think we wish that the party continues.
Okay. Thank you very much, sir. On that very positive note, thank you very much for joining us.
Thank you, Mr. Swaminathan and Lata, for that engaging discussion. Moving on to another enriching discussion titled Redefining Banking Excellence, Navigating Challenges and Opportunities. The banking sector is at the forefront of significant transformation, and banks must continuously innovate and adapt to meet the demands of a changing world. To explore the challenges and opportunities within the banking sector, we are honored to welcome a distinguished leader whose impact on the financial world is both profound and lasting. He's been a beacon of innovation and strategic vision throughout his illustrious career. Under his leadership, State Bank of India has navigated periods of significant change and emerged stronger, setting new standards of excellence. Please welcome on stage with a huge round of applause, Dinesh Kumar Khara, former chairperson, State Bank of India. And to take this conversation forward, I would request Shireen to kindly join Mr. Khara on stage.
Well, ladies and gentlemen, a big round of applause for the RBI Deputy Governor, Mr. Swaminathan, as he leaves us. Thank you very much, sir, for joining us here this evening. And it is my pleasure now to welcome here on the Banking Transformation Summit stage, Mr. Khara. Mr. Khara, what an honor it is to have you join us today. Ladies and gentlemen, a warm round of applause for Mr. Khara for completing what has been a stellar tenure at State Bank of India. And I'm just going to take you through some very quick numbers of the kind of impact that he's made at SBI after he took over as chairman on September 2020. We've seen deposits grow from about 3.03 trillion rupees in Q2 of FY20 to 4.9 trillion rupees in Q1 of FY25. We've seen advances grow from 2.15 trillion rupees in Q2 of FY20 to 3.81 trillion rupees in Q1 of FY25. We've seen net interest margins go up from 2.9 to 3.22. It's just a very quick snapshot of the kind of growth that Mr. Khara has navigated at India's largest bank. So, Mr. Khara, congratulations on that and congratulations on a wonderful tenure. Let me start by talking to you about the long innings that you've had at State Bank of India, starting in 1984 to when you retired yesterday and hung up your boots. What would you say have been the big milestones that you witnessed? How would you characterize the big changes that you witnessed in your career?
First and foremost, thank you very much for having me here. Well, when we look back, 40 years back, the banking was absolutely a different world. People today cannot even imagine what it used to be. And today, when we are in 2024, when we look at the banking has actually overgrown beyond what the banks were. I think we have started leveraging technology in a very big way. It's not merely the computing part of it, but we have started leveraging analytics in a very big way in terms of profiling the risk. And also, there is a very distinct effort on the part of all the banks, how to win the customers, how to win their mind share. So I think it's a paradigm shift, if I may say so, in the financial sector and the banking industry, which you have witnessed. And of course, over the period of time, the evolution of risk have undergone a significant change. And also the ability of the banks to understand, assess the risk, and initiate the mitigation measures in good time. That, I believe, is something which is a definite change as compared to what we have seen in the past. I think I would say that it has been an interesting journey. Perhaps not many bankers would witness a scenario where they start their career in the physical ledgers, and by the time they demit the office, the banking is on the mobile.
Yes.
So from if I look back, it's a huge transformation which we have seen. And of course, on the part of the human resources, skill set, there's a huge investment which is now being made in terms of ensuring that we have the technical skills and we keep on upgrading those skills on an ongoing basis. So, interesting, challenging times. Just to ensure that the bank should stay ahead of the curve, one has to invest quite a lot.
Well, you know, since you're talking about interesting times as well as the opportunities and challenges that lie ahead and staying ahead of the curve, let's start by talking about technology, the transformation from physical ledgers to now banking on your mobile phone. And the perception was that the banks have been slow to the party, and I'm taking the liberty of using Mr. Swaminathan's phrase. And more importantly, public sector banks have been even later to the party. But, you know, what was that like to dispel that perception, to dispel that notion, and to disproportionately invest your resources as well as your money on trying to build out the technology side of the business? You've been a big believer in that. Has been something that you've been pushing at State Bank of India very, very passionately. You've championed that. But both the internal perception battle and the external perception battle, which was harder to fight and overcome?
Yeah, rightly said. I would like to go back to the year 1990, the year when the banking sector got opened up and the new banks were, private sector banks were given the new licenses. That was a point of time when legacy banks like us, we could realize that yes, there is a time that we need to think differently. And actually speaking, we as a leading lender, we look beyond the banking also. We came out with our various companies, which are investment management company in the shape of a mutual fund. We came out with the investment bank, SBI Capital Markets. We came out with SBI Life, SBI Journal. So essential idea was that how do we have to win the mind share of the customer and offer them the comprehensive product range, not merely the banking. So this is something which we started doing then. And also, due focus on the digitization, because when it comes to volumes, we have always been processing huge volumes, but how do we actually bring in the efficiency of processing? That is something around that time we started adopting the digital, and at that point in time it was actually it was not centralized computing, it was distributed computing. Each of the branch used to have over the period of time when the ecosystem evolved, the IT system was available. Around the year 2000, we started getting into the core banking. So it was all centralized computing. It actually gave a lot of efficiencies to the operation. So as against having the IT talent available with each of the branch, we could centralize it at one location and support all our branches. So this is something which happened. But yes, of course, I would say that yes, of course, perception has been that the public sector banks are the laggards, but I would say that we invested not only in terms of technology, but also broad-basing the product range also, and which actually helped us in ensuring that we should have the mind share. Particularly, I would like to draw your attention to the year 1990. That was a point of time when actually the corporates were looking at expanding. And capital market has always been very shallow in this country. Yeah. And that is the reason why perhaps for really building up the infrastructure, building up the assets, banking was the way. And how to really help them out. This was something which was done by our investment bank. And of course, now it's a history. Not many people would know it.
Well, let's talk about the future, sir. And let me talk to you in the context of the efforts that you championed at State Bank of India as far as the merger of your subsidiaries with the bank were concerned. And today, you're not a regulated entity, so I would expect perhaps a much more provocative response from you. Do you believe that we are ripe for further consolidation in the PSB space, or do you believe that that is something that is no longer a priority or no longer a need either?
No, actually, if you really look at it, today when it comes to the compliance cost is mounting every other day. That is one aspect. The second aspect is now with the DPDP Act coming into play, and the kind of obligations which are involved into the DPDP Act, an entity which is not big enough to really understand, comprehend and implement all those provisions, they might face challenge. So I think it is not a matter of size, big or small. It's a matter of understanding and comprehending, and also assessing the ability to be compliant. We have seen across the globe, there are many tech banks. They are very small in size, but they have got the ability to understand that compliance risk and handle that risk. So I think if at all an entity can assess the risk and handle the risk, they can have an existence. There is always a room for niche players. There is no need to merge everybody. So niche players can perhaps do even better if at all they are left alone.
So room for everybody. You don't believe that there is a need for large consolidation at this point in time?
Consolidation is worth pursuing if at all it adds some levers to the organization. Be it the growth levers, be it the ability to differentiate, be it the ability to deliver better. So unless and until there's a merit in the consolidation for the sake of consolidation may not really yield the desired results.
Is privatization something that should be pursued or not be pursued?
See, I would say that privatization of public sector, ownership agnostic, this is what I've always believed. We are owned to the extent of 56.92% by Government of India. But we are owned to the extent of 44% by international investor. Out of that, 12% are the international investor and the remaining are the domestic investors. So when we engage with our investors, we don't carry the mindset, though I have to repeatedly tell them that management or the efficiency is agnostic to the ownership. This has been my repeated phrase when I used to engage with our global investors. So I think it has nothing to do with the privatization or public sector.
But is that an overhang? Because is there a credibility issue when you might say that ownership is agnostic? You are ownership agnostic, but is that believable?
See, I have seen that in last about 4 years' time. When I assumed office, the stock was around 190 rupees. When I demitted office, it was around 815 rupees. I believe they bought my argument.
Yes, the market certainly seems to believe that argument, Mr. Khara. But since we are talking about the road ahead, we're talking about the future as well. Given the aspiration that we have, the first milestone that we hope to achieve is 10 trillion, and then of course the developed economy by 2047, which is the larger aspiration for the country. What is the challenge for India's banking sector to deliver on the promise of that kind of growth?
Yeah, you rightly, because this is something which keeps on engaging the mind always. One, of course, to really achieve the kind of growth which we are aiming for as far as the GDP is concerned, we need to have the decent savings rate. We need to have the better input-output ratio, which means the productivity and the efficiency of the resources, the way they are being utilized. They need to be, I think there is a scope for improvement. And once we do that, and perhaps with the use of technology, we are in a position to improve the capital output ratio significantly. I'm sure this will go a long way in terms of giving the muscles to the economy, in terms of generating the kind of GDP which we are aspiring for. And of course, on the top of it, we have to identify the sectors which can actually be the lead sectors for the economy to grow. We have already seen that when it comes to the capacity utilization in the economy, it has improved. Government-led investment has actually shown the way for last about 3.5, 4 years' time. We are seeing decent opportunity for the private sector investment also. Export, invariably, we have seen that when the economy moves from the current level to the next level where we aspire to be, export should actually become one of the leading sectors for the economy. We have been a leading exporter of the services sector. We have to become the leading exporter of the manufacturing too. You would agree that when it comes to auto and auto components, we are already ranked number 4th in the globe. But when it comes to, now we are embarking upon a new era, which is essentially renewable energy, which is now we are looking at solar module manufacturing, solar cell manufacturing. We are looking at this new technology related developments. These are the new levers of growth, and it actually today, post this China Plus One strategy, which is being followed across the globe by many of the countries, hopefully this will give us an opportunity. Of course, we have experienced the global headwinds. Perhaps once the global headwinds are a little slow down, we'll have an opportunity to see the export sector also growing. And with the export sector growing, I'm sure it will have a significant improvement in the employment conditions, which will actually give the fillip to the domestic demand as well. So I think all this will propel the country into the next orbit of growth.
Well, speaking of propelling the country into the next orbit of growth, what is the note that you've left your successor with? On the back of what you've been able to deliver in the last 4 years at State Bank of India, what have you told Mr. Sethi to focus on?
I think, in fact, Mr. Shetty was part of my core team all these 4 years, and all of us have taken that decisions collectively. So I was not required to leave any specific message.
There must have been something,
because he
sir.
himself has seen that the steps taken or the decision taken, how they have yielded the result. So he has tasted the success of those steps. Now it is for him to take the course.
It's for him to take those steps forward. But, you know, since we were talking about technology, and I'm asking you in the context of something that everybody is grappling with across different sectors, including the banking sector, what will an AI-led, AI-driven world look like? What is it going to mean for jobs? What is it going to mean for banking? What is it going to mean for State Bank of India?
No, it's actually, we have started leveraging AI already. And when it comes to various repetitive tasks, we are in a position to handle through AI. When it comes to analytics, when it comes to profiling the customer behavior, we have started using AI ML, and also when it comes to working out the risk models, this is something which is turning out to be very handy. Virtually visualizing that what are the contributing reasons for various frauds which happens across outside, inside frauds, and what all are the early warning systems. So all this has been put to good use, and I'm sure going forward, we'll have even more use cases. We actually started engaging with we joined hands with the IIT Bombay to develop the models relating to AI, which can be put to use in the bank. But there is always something better which we can do. And I always used to say, Dil mange more.
Dil kya mangta hai, sir? Is moment pe kya mangta hai?
Dil mange more in terms of the ROA, dil mange more in terms of ROE, and of course, the profitability of the bank.
And where do you believe the profitability could be, given the many opportunities you spoke of?
My very firm conviction was last year, though we declared profit about 61,000 crore. But actually we had made one-off provisions, which if at all we would have ignored those one-off provisions, the profitability was 83,000 crore. The bank had a number of 1 trillion. So 1 trillion net profit.
What? Sorry?
1 trillion net profit.
1 trillion net profit, that was the aspirational number that you were working towards.
That's in the immediate future.
The immediate future, and that's perhaps the target that you've left Mr. Sethi to deliver on. So let me end by asking you, sir, Delhi or Bombay? Dil mange?
Maybe both.
Maybe both. Dinesh Khara, many thanks for joining us. Ladies and gentlemen, a big round of applause for the former State Bank of India Chairman, Mr. Dinesh Khara.
Thank you very much. Thank you.
Thank you, Shireen and Mr. Khara, for that fun, candid and insightful chat. Request Shireen to kindly present a memento on behalf of CNBC-TV18 to Mr. Khara for his leadership and outstanding contribution to the banking industry, sir. Ladies and gentlemen, a huge round of applause for Mr. Khara. Thank you so much, sir, for joining us here tonight. Thank you, Shireen. And now, ladies and gentlemen, it's time for the first panel discussion titled Filling the Credit Gap to Fuel Economic Growth. In the pursuit of robust economic growth, addressing the credit gap remains a critical challenge. As India continues its journey towards becoming a global economic powerhouse, the ability to provide adequate credit to various sectors is crucial for sustaining momentum and driving inclusive growth. To delve into strategies and solutions aimed at effectively filling the credit gap, I would request Lata to kindly come back up on stage. I would also like to invite the panelists for this session. Please welcome A.K. Tiwari, Managing Director, State Bank of India, Prashant Kumar, Managing Director and CEO, Yes Bank, and Ashok Vaswani, Managing Director and CEO, Kotak Mahindra Bank. Over to you, Lata.
Mr. Tiwari, Mr. Kumar and Mr. Vaswani, thank you very much for indulging us. Banking, never a dull moment. And the Deputy Governor has already given us some leads into how the regulator is thinking. Actually, taking a cue from what Mr. Swaminathan said, let me start there. He said we are in a high part of the cycle. Everything moves in cycles, so does finance, and we are at the high point of the cycle. So let me start with that question itself. Are we past the high point, Mr. Tiwari?
So I would say finance is a derivative industry. It's not on its own. So if the underlying industrial cycle is on a downswing, finance might also come to a downswing. And as long as we see the underlying cycle is still going up, I don't think we are going to go down at this point.
Well, at the moment, I can tell you that the GDP is at 6.7%. The Q1 GDP is the lowest in 5 quarters. It is lower than the previous quarter, lower than the year ago, same quarter. It was 8.2. Previous quarter was 7.8. At 6.7, we are at the slowest in 5 quarters. So, anyway, separately, I mean, we've got a very good NPA number for the industry at 2.8%. I mean, when did we last have it? I think this is historically the lowest GNPA that the banking sector has had, which is why I'm asking, is the best behind us?
So it may continue for some more time. Of course, you can say that this number, which is at the lowest in a long, long time, perhaps is too good to last. Okay. Because as things change, then there will be some...
It doesn't get to 2.7 before it goes to 2.9?
We don't know. Okay. That we can't predict those things. But my general sense is, and to your earlier point also, that this cycle, everything is cyclical. But I think the banking system has also learnt its lessons. The underwriting quality has improved. There is also the risk assessment and the appreciation of risk has also improved. I remember in earlier times we would do a project assuming that land will be acquired. No longer. Unless it is 90-95% acquired, we would not disburse anything today. So I mean, those kind of examples, a lot of improvement has happened. So I think we are much better prepared to face a cycle as and when it arises. Things would be much better than previously.
Well, I must just tell our esteemed audience, you already know, that until now, the 3 people who have spoken are all SBIites. I mean, we had Mr. Swaminathan, and then we had Mr. Khara, then we had Mr. Tiwari. So I'm going to skip Mr. Kumar for the moment. That will be a 4th SBI. So let me pose the question to Mr. Vaswani. What is your sense? I mean, we are seeing a rise in MFI loans going NPA, trouble with them, trouble with unsecured loans. A lot of credit card loans are seeing trouble. So do you think we are just past the best? Instead of the banking sector going from 2.8 to 2.7, do you think that we have bottomed out in terms of NPAs and now we are going to see a rise in risk?
Lata, I like the comment that I think Mr. Khara made, which is the best is yet to come.
Okay.
I don't think there's a doubt about that. I think, look, at the end of the day, these things do move in cycles, but for the long term, is the banking sector in India in a much, much, much better position than it has been in a very, very long period of time? That's absolutely true. I think the banks have understood and learned how to deal with these kind of situations. The regulators actually have done quite a remarkable job of kind of managing it. Yes, there will be some kind of ups and downs. This cannot be just, 2.8 is not going to become 2.6, 2.4, 2.2 to 1.8. There will be ups and downs, but I generally think the banking system is in very, very good shape.
Okay, let me put it this way, Mr. Kumar. This is a crowded trade. I mean, time was when people competed in terms of corporate and infra lending. Now, there is a complete migration to retail, and to add to it, you already have NBFCs, the likes of Bharat Finance and MMFSL and, the Srirams of the world who are already in retail, and you have fintechs, the kind of the new banks. So it's a crowded trade. So do you think we are reaching a stage where we are bound to see more NPAs? Maybe you have the money to provide for it. I'm not taking that away. Your NNPAs may be the lowest, but are we going to see an uptick in unsecured loans at least going bad?
I think we need to see in terms of what are the opportunities available. When you were talking about a crowded train, I think we should not restrict in terms of like train is having only 10 bogies, each bogie is having 90 seats. We are talking of 140 crores Indians. And I think we were also talking about some numbers we are giving. If you see the coverage for our population, which are part of the formal credit, is a very, very small as compared to any other geography. So I think the opportunity which lies is sufficient for everybody, whether we talk about banks, NBFCs or the fintech. I think important thing would be how to reach to the last mile. And I think this is what banks, fintechs and NBFCs are attempting to do together.
So it's not as if you're lending more to the same person, you're lending to new to credit people.
More bogies keep getting added.
I take your point. It's no longer 10 bogies. I take your point on that. But actually, let me expand on that point. The other issue which, the other abbreviation which has now become very popular with the Reserve Bank is not UPI but ULI. Ms. Tiwari, where do you think we are on ULI? Do you think we are very close in the sense, has a lot been digitized? How are the account aggregators doing? Are we getting into ULI in a few months?
So ULI, I really can't comment because basically it's based on the platform which has been set up.
You will be involved in the platform.
No, we are involved. So there is the platform already set up by RBI on which the Kisan credit card was launched, as the governor was explaining. So that's the pilot kind of stuff. This has been done. That was pretty smooth and pretty good. Now, when we want to bring in all kinds of loans, then there could be some different shades. So we have to see how that goes. But my sense is that this would be a good platform for low ticket, large volumes, and with information which is integrated across, because one of the challenges we face currently, that for example, GST has been touted as a initial this thing, but we need a consent every single time, which means an OTP on the borrower's phone. And that's a very practical difficulty which we face.
When the borrower wants money, would he not check the box in terms of you can access my GSTN?
Yeah, only one time.
It's not smooth.
One time.
Okay.
So once he consents, that means he tells us the OTP, we will be able to do that. But we need to monitor these loans all the time.
Oh, okay.
So it has to be a continuous thing. I mean, in our regular...
So at the moment, that is not in place?
No, it's not there. It's not there. This is something we've been taking up with the authorities.
So when he wants the loan, he gives you the consent. But when you want to monitor the loan, he is not yet giving you the consent.
Consent means the OTP every time. Okay. That's a consent, byword for consent. So that's those kind of things, some of those have been solved in this platform. Okay. Because there is, if these kind of enablers
the repeat consent is solved in the platform.
Solved in the platform for the time being, and now we have to see what more can be done. There could be other things also which are being thought about. And if all of these things are done, then I think it would be a very good platform for a very basic platform for low ticket, large volumes, and at the base of the pyramid, which is a high cost item.
So you see it as for personal loans, SME loans?
Yeah, I mean, all I'm saying is for people who do not require very large amounts of money, small ticket, like we have all these fintech platforms, the repeat loans, etc. This can all transit easily here. And the other thing is that since it's a Reserve Bank-led thing, the trust and the confidence in this platform will be pretty high. The data will be used exactly for the purpose it is meant for and not used for other purposes, which currently is the case. And therefore, it can be a very good model How it pans out, we'll have to all work together on that. We do not have enough details at this point of time.
Actually, that was the doubt that occurred to me also when the governor announced the unified lending interface. There are, what was it, Vivritti or one of those platforms are already available where a bunch of banks look at SME loans, right?
So we have multiple platforms. For example, the PSB Online Loan in 59 Minutes is a platform which is there. And there are 2-3 platforms like this. The only thing is that many of these platforms have different shades.
Okay.
And not everybody has the same enablement. Okay. So we have to see how this pans out. I mean, for example, the RBI led the NEFT and the RTGS platforms. And today, we don't even associate RBI. They are very well recognized. So if such a base gets built, I think it would be good for the industry overall.
Okay. What's your sense, Mr. Vaswani? Do you think we are very close to having this kind of a platform? The RBI seems to be of the view that if you are a SME and you're bidding for a loan, you just get onto that platform and various banks can actually bid for your loan. That's the end game they're looking at. Is that anywhere close? Since we are talking banking transformation, how far is it, you think?
See, Lata, I think India's public digital infrastructure, which has been built, is unparalleled. I have not seen anything like this anywhere in the world. Anywhere in the world. Okay? And it continues to progress at a dramatic pace, right? Now, there's lots and lots of good things about it because it leads to the democratization of availability of finance, which is a good thing. I think we will have, it obviously leads to greater competition. So therefore, the banks will have to learn how to compete in this new area of heightened competition. I think the bankers will have to learn new skills, how to leverage data, how to leverage technology, right? When I started, if you were a chartered accountant, you know, you were golden for a bank, right? Right now, I guess an engineer is more golden for a bank because those are the people who can actually build these kind of systems. So these changing skill sets, these changing kind of demands on banks is going to happen, right? In general, this is only a good thing. Of course, we've got to be a little careful because these systems are also exploited by the bad boys, and you can hear about digital frauds, and you hear about, you know, scams and stuff like that. But we then as bankers have to figure out ways, right, where we can really take advantage of this. Every single element of it may not be ready today, but it's a matter of time. And I think we're marching ahead to a very, very exciting kind of future for financial services.
No, that point is taken that both our public infrastructure, digital public infrastructure, and the fact that we are marching ahead in terms of inclusion at a pace which we would never have thought would have been possible.
I'll just make a very quick point. Actually, for a country like India with so many people, we need multiple digital public infrastructure platforms. So one is to have the ease across all these, and second, more importantly, from a cyber security point of view also,
it's just as well that we
each is a BCP for the other.
Okay, it's just as well that we have private platforms as well as you know, an RBI-sponsored platform. But what about the cost, especially when it's not a large bank, Mr. Prashant Kumar? An ex-City banker had said that I am only a technology company now with a banking license. It's come to that. Every bank has become a technology company. Do you think small banks can continue in the fray given the kind of RegTech and SupTech that you'll have to put in?
No, I think the issue would be whether you have the right kind of solutions. Okay. Technology always comes with the cost, but also in terms of efficiency of doing very large business within a small entity. So I think depending on adoption for the right kind of technology, you continue to need to invest, but also it helps in terms of efficiency.
So you think there is a space for small banks as well? Or do
Absolutely.
you think just everyone has to merge because of the economies of scale of technology?
No, economies of scale is one part. But I think in terms of your ability to move very fast, I think that lies with the small institution.
Okay.
You become very large, and then there is your speed becomes slow.
Okay.
Lata, I take
your
actually
point.
a different view on that because I'm saying instead of merging or having to become a big bank, today with the technology infrastructure that is available in the public space, right? With computing costs going down, with ability to do things on the cloud, with risk analytics, your ability to actually set up a bank with far less infrastructure is much easier. And in fact, you've seen it in the technology space. You look at the US, every of these small technology companies have started and scaled, and look at the valuations they've got.
I take your point. I mean, that's one reason why India could leapfrog. We did not have to scratch out a legacy system. I mean, we started off with state of the art. I take your point on that, but still technology costs seem to be mounting so much that sooner or later, perhaps the bigger boys have an advantage. But let me come to the hottest topic of the day, deposits. What's your sense, Mr. Tiwari? Do you think costs have to go up before they go down? The rate at which people are, competing for deposits, even warring for it.
So warring is a very strong word, but deposits, there is clearly a competition, because if every bank wants to fund its credit growth, and traditionally India has had always 90% of the loan growth has been funded by deposits. If that be the case, clearly as loan growth outpaces deposit growth, at least for the near future, there will be a challenge on deposits, and therefore as a natural corollary the rates might go up, and they have been going up in different buckets depending on each bank's own this thing. As far as we are concerned, as you know, we are still below 70 in the last quarter in terms of CD ratio, so we don't have that much of a challenge. But at the same time, deposit is always a franchise, so you can't say that we'll stop gathering deposit right now. It has to continue, the relationship has to continue, and therefore my sense is costs might go up a little in the short term, but ultimately it will all stabilize, and then we will have the usual revert back to the normal as it was some time back.
Is it a given that for the industry margins will come down in the coming quarters because the cost of the raw material is shooting?
So as the deposit cost goes up and the loan prices do not go up as much, because they are already at quite a peak, and therefore
you have another problem. Your loans are benchmarked to T-bills and they are not rising.
T-bill, MCLR. So T-bill is actually coming down. Without the rates being cut, the T-bill rates have gone down by 40 basis points in the last 1 or 2 months.
So for the sector, you think...
So for certain shades, yes, the margin would reduce, and therefore we have to find out new areas, new avenues where we have to protect the margins overall, and also surround services. It cannot be only lending and deposits. It has to be a complete banking bouquet, which will add to the bottom line ultimately. That's what it matters.
What's your sense, Mr. Kumar? Do you think for sure, I mean, the market is screaming, it's pushing up all stocks, but Bank Nifty is the last to rise. So do you think that we have to reconcile to lower margins in the coming quarters?
No, I think first we need to see this issue about this deposit, which I think we are talking about.
Yes.
I think first we need to understand what is the ground reality. Data shows that the industry deposit growth is around 11%, as compared to 13% which was happening last year. I think it's important to appreciate why this is happening. Okay. First, there was a lot of deposit which was sitting in the banking system because of the inefficiencies in the government functioning, which has improved a lot. Now, with the kind of efficiencies which has come to the government systems, I think the surplus money which was there in the entire banking system
is sitting with the government now.
Has moved out. So there is always inefficiency.
No, they have 4 lakh crore. I mean, maybe it's
Whatever.
a little less now.
The
but
second part,
unspent government money is very much a problem.
The second part in terms of when the regulation has come in terms of you can't open a current account with a non-lender. Okay. Now what is happening that the money which was parked in the current account with some non-lender is actually now moving into the cash credit of the lenders. So that surplus money is also not there. The third part in terms of the household savings, which was coming to banks, now either they are getting invested in some other assets, productive assets I would be saying, and also for some high earning assets. This is the ground situation. If the deposit growth would not be equivalent to what was happening earlier because of these major things, I think it is important that how you expect from the banks. Okay. What I am saying, there was a discussion in terms of that ultimately any money which is coming to mutual fund would come back to bank.
Exactly, it is
No.
in the banking system.
No, it's not like that. Money would not come as a retail deposit. Money would come as a
In the current account of the mutual fund.
wholesale deposit. But you are actually monitoring the banks in terms of what is the contribution of the retail deposit. What is the contribution of the bulk deposit? I am only saying if these are the changes which are happening, we need to monitor the banks from a slightly different angle. Why there should be so much dependence only on deposits? A bank in terms of
So
liabilities.
you see the CD market booming.
No, it's not only CD. There are borrowings.
Okay.
I am saying there has to be a combination of deposits and borrowings, which takes care of your loan growth. And similarly, your expectation in terms of how much is coming from retail or wholesale is a difference. Now, if you see the money which is coming to mutual funds, they would not be parking in the current accounts.
Yeah.
They would be doing the liquid funds, which are investing in the GSEC. So it is not like everything is coming to the banking
Banking
sector.
system. Okay. No, I take your point over there, but you've almost agreed that there is going to be a pressure on margins.
No, I'm not saying that. I'm only saying the deposit, this is what the industry would evolve.
Okay.
Everybody would understand this is how the structure would change.
Okay, I take your point on that, but still, the second largest bank is giving 8.2% for a 100-day deposit. So, on that point, Mr. Vaswani, isn't it inevitable that your raw material cost is really going through the roof, and therefore we have to be prepared for lower margins?
See, look, the way I look at it is these things happen in cycles, and there are multiple cycles that are at play here. I think he made some very good points around how the government has become far more efficient in managing their money. Obviously, we are seeing a cycle with the individual customer, that the investments into capital markets is kind of going up. Eventually, these things will find equilibrium. So will there be a quarter, 2 quarters, 3 quarters of some kind of disruption? We're already starting to see that. So that is not new news to anybody, right? That will continue, but eventually some kind of equilibrium will kind of come up, and market forces will force it. Right? Everywhere in the world that you see, how much ever, as a country develops, the balance sheet of banks change. There is no question about that. And that is something that we are going through, and that will continue to go through. So this is to my mind, it's a cyclical kind of
cyclical and not transformational. So let me use the last 10 minutes that we have for transformational questions. Okay, one of the things I wanted to ask, okay, let me start with you on this issue. Are bank branches becoming a thing of the past? I mean, do you think that the hunger for more branches may not be there because we've become so digital?
So I'm a very firm believer that there is a solid place for branches. Okay? There is a solid place for branches. What may change is the quantum of branches that you required.
Maybe the size of the branches.
The number, the size, what happens in a branch, and what you use a branch for. All of that may change, but the need for a branch still changes. How much ever we talk about Gen Z and millennials and stuff like that, for complicated financial services product, there's always a need to have a conversation. We saw in COVID also, at the end of the day, a person-to-person conversation is always preferred to a kind of call conversation. So there will always be a need for branches. The quantum, the size, what happens in a branch will change.
Okay. What's your sense, Mr. Kumar? Branches have not gone out of fashion?
No, absolutely not. Because ultimately it is about the depositors. I think the confidence of a depositor in any bank would come if they are able to see the physical presence of a branch. But I think the format of the branches have changed. Maybe earlier we were talking about a 5,000 square feet branch with 20 people. Now you are opening branches with 800 square feet, 1,000 square feet with maybe 4 or 5 people. Because maybe 90% plus transactions are happening on digital, the entire customer acquisition. But I think for a depositor to have a confidence that this bank is there, and if there is a problem, there is an outfit where I can go and my problem can be addressed. So I think it is important to have a adequate branch network in the entire area. the formats would change, the cost would come down, and it would be more in terms of troubleshooting and some of the sales.
I'm not asking that question to the man who anyway has the largest number of branches.
No, I'll just add.
Is there a district where there's no SBI? I doubt it.
No, there is none. But in addition to the 22,500 branches, I would argue that we also have 82,000 points of presence as the business correspondent model. I think this model is also extremely important as we go along, and we are looking to enhance and strengthen this model because for not only small value transactions, but multiple other services which they can offer. We already offer 32 services from those. So I think we are more than 100,000 branches, if you would call in that sense.
Fair point, fair point. There are other ways in which you'll have cyber branches probably. Okay, I want to use the last 5 minutes for a rapid fire, but just one more transformational question, and let me start that with you. We are seeing finally India getting long-term pools of capital. Bank deposits are growing at 11%, but insurance plus pension money is growing at nearly 20%. And the total kitty now is 115 lakh crore, not very far behind the 200 odd lakh crore, which is bank deposits. Plus, you have this large amount of, global money because of India's bond index inclusion. Do you think we are on the cusp of a corporate bond market evolution? Because there's so much of, longer term money sitting, do you think corporate bonds will be able to finance infrastructure? You see it happening?
That's the hope, because in every developed market and every other market which has had a lot of infrastructure growth, corporate bond market has played a very, very important role. And in general also what we have seen is that banks may fund the initial project, but as the project comes on stream, starts to generate cash, then it gets taken out by the corporate bond market. So that's clearly the hope, but I think a lot of work needs to be done still in terms of the bond market as it stands today, so that the less rated corporates, because today AAA and AA is all that is able to raise money easily. The double Bs, triple Bs and all don't. And my sense is, I always compare that if you can lend to a single B or a double B, then what prevents for the bond to come in and we can invest in the bond as well. But a lot of work needs to be done across regulation, across pricing, across rating, and various other things like these pension funds and the insurance you talk about. Most of them don't have a mandate.
They won't go below AA.
Yeah, yes, exactly. So if they are not allowed to go below AA, then how do you think that bond market is going to develop? So much work needs to be done. But it's getting there. It's getting there.
Okay, the rapid fire I start, the first one is not too rapid. I want each of you to give me one sentence on what is your idea of transformational banking. 5 years down the line, what do you think will be the one big change in the banking space? May I start with you, Mr. Aswad?
I think artificial intelligence is going to change everything. And I think that's going to change cost bases. That's going to change the way we interact with the customer. I think that's what's going to drive a lot of the transformation.
So your due diligence will change?
Not only due diligence, everything. The way we spot a customer, acquire a customer, service a customer, deal with the customer, everything will change with that.
Okay. Mr. Kumar, your idea of transformed banking?
No, I think it is more in terms of if you can really support the economic growth of the country. That would be the real transformation of a banking or any bank, where it has to be a meaningful contribution in the Indian economy.
Okay. No, I would think that Indian banking already done that, but that is leading me very clearly to the next set of rapid fire. But your idea of transformational banking, so how will banks look 10 years from now?
So this is a wacky question. Banks would look largely what you see today, but my idea is a bank in a pocket. So all the mobile, everything, and it should not only be go into the app and do everything, just speak to the bank, mobile, and things get done. So we have to reach that, because otherwise we have a lot of people outside. The smaller phones, the feature phones, they don't participate in the digital banking.
In that case, you guys will not give us off-the-record statements at all, because it's always on the record somewhere. Okay, the other rapid questions I want to ask you. What do you think is going to be the bank credit growth over the next 3 years? What's the average, you think?
Are you asking me for a percentage?
That is the rapid question.
Look, banking sector grows at about 1.5 times GDP growth. That's usually where it goes. So
now you tell me, what is the GDP growth as well? Are you forecasting 7? Are you forecasting 8? Are you forecasting 6?
So I'm not an economist. Far more superior people can be economists and tell you that. But I think we should peg it at about 1.5 times GDP growth.
But in that case, you're saying that it would be more like what? You take nominal GDP growth, so say 10% GDP growth, you would expect only a 15% credit growth?
So on the margin, I mean, the industry goes at about 15. There'll be people who will go slightly lower, slightly higher.
Okay. What's your sense, Mr. Tiwari? I'm trying to dodge.
This is really rapid. But my sense is anything between 15 to 18%.
Yes.
Yeah, because so much is happening. I mean, all those, you talk about retail, but there's so many people coming into the banking system. There's so much of industrial growth happening, so much of push on all sides, 15 to 18.
Okay. Mr. Kumar?
So I think if we aspire to be a $10 trillion economy by 2030 and Viksit Bharat by 2047, I think the credit growth has to be in the range of at least 15%.
Okay.
Now, whether it is coming from the banks only or from the bond market, I think my answer would be a combination of both.
Okay. Well, I think we'll have to call it a day. There is a very important NBFC and Fintech panel also waiting by. Thank you very much, Mr. Tiwari, Mr. Kumar, and Mr. Vaswani. I think for me, the big takeaway is that banking is going to be in your pocket, but branches are not going out of fashion, and Indian banking is prepared for a 15 to 20% growth. On that note, thank you very much.
Thank you.
Thank you so much, Lata. Thank you, Mr. Tiwari, Mr. Kumar, and Mr. Vaswani for joining us here tonight. Well, it is time for another fireside chat this evening on the topic Future-Proofing Banking, Building a Resilient Bank. To dive into how banks can build robust frameworks and to navigate the uncertainties of tomorrow and emerge stronger, we have with us the distinguished figure in the financial sector who is known for his exceptional leadership and innovative approach. Under his stewardship, Federal Bank has embraced technological advancements, redefined operational resilience, and strengthened its market position. With a huge round of applause, ladies and gentlemen, please welcome on stage Shyam Srinivasan, Managing Director and CEO, Federal Bank. And to moderate this session, I would once again request Shireen to kindly come up on stage.
Conversations continue here at the CNBC-TV18 Banking Transformation Summit. You heard from India's best bankers, and it's now time to hear from another one. Mr. Srinivasan, what an absolute pleasure it is to have you join us here this evening. A side story, just before we were walking in, he said, look, don't ask me boring questions, let's have some fun. So your wish is my command, Mr. Srinivasan, so I'm going to start by asking you, do you believe the RBI should have a say in capping CEO tenures?
I can actually say it. I have only 25 days left, right? So, I see, if their belief is that a long-serving CEO may be up to mischief, I can't argue about that. That's the perception. But I would like to have continued for a few more years. That I can say.
So not ready to hang up your boots just yet.
Far from that.
Far from it. So let's talk about, if you had another 14 years at Federal Bank, what the Federal Bank story could potentially look like, and what the Indian banking story could look like. I remember you said once that you gave an analogy of comparing Ayurveda and Federal Bank. You said what Ayurveda did for Kerala, Federal Bank has done as far as Kerala is also concerned. You've taken it out of Kerala, you've given it to the nation. And I want to understand from you, over the last 14 years, the complexion of the bank has changed. There has been a diversification as far as your deposits are concerned. What's been the most heartening as well as the most challenging aspect of that journey?
Challenging one is answering questions like the ones that you asked. The heartening one, I'll tell you, Sirin, the fact that when Shruti introduced Federal Bank and pointed to the fact that we are a prominent player in the banking space today, we are literally knocking on the doors of being the top 5 private sector banks. Right? I heard when SBI chairman was speaking, thank you, when SBI chairman was speaking and the introduction was, it was a 60 lakh crore bank, right? Today, we are 1/12th of SBI. When I took over, we were 1/20th of SBI. So the fact that rate of growth of Federal is much higher than the industry is in some sense heartening, because today we are, I always say, right, you're either on the table or in the menu. I think we're slowly getting into the table. So hopefully we are not the menu and I'm getting So that's what I would say. Yeah.
Well, you're talking about this scorching pace of growth under your tenure. What do you believe has aided the kind of diversification that you've seen, also the pace of growth you've been able to deliver on? What would you classify as the 3 or 4 things that you did differently that have helped you achieve this?
I have no personal credit. In fact, tomorrow is our AGM. I was just writing my speech for our shareholders.
So give us a sneak peek of what you're going to say.
I will share. It's not, just statistics, right? Our business has grown 7-fold, and our profits have grown 7-fold, and our market cap and net worth have all grown 6-fold. So numerically, we have done well, and you can't argue, it's a fact. But I think what we take great credit is we unlock the belief that people, ordinary people coming together can do fantastic stuff. And I take extreme pride, and I hope that's the mantra that we will leave behind. We have no point claiming any victory. In fact, my personal philosophy is we are happily dissatisfied. And we're happy, but always dissatisfied. And I think it's a good place to be in. I do believe that's the bank's philosophy too. I think everybody genuinely believes we can be on the table. And therefore, there's a lot of effort, there's restlessness, there's an ambition to do good stuff. And so if there's one thing we've accomplished over the years as a bank, I would like to believe it's about a genuine belief that a bunch of ordinary people can come together and do good stuff. And I think that's happening.
Well, that does deserve a big round of applause. And yes, I do believe that magic happens when there is alignment of vision and alignment of execution as well. But, let's talk about the next 4 years, because the aspiration for you has always been to try and double the bank in 4 years. And do you believe you're on course to being able to achieve that?
It's 4 or more plus in that zone. See, if you grow 18% a year, then you will naturally, double anything in 4 years' time, right? So that is very possible. Yeah, there are near-term headwinds. If the economy and the deposit challenges prevail, you may slightly dial down to 16 and then you'll catch up. But I think 4.5 years, doubling the bank is very possible, as we have. I mentioned the numbers to you just now. We have, I think, a CAGR of 15% over a 14-year period. There are only 2 other banks that have done that over this extended period of time. And I think our platform is, in a good space right now. Ability to grow is 16, 18, 20, depending on the environment. I do believe it's possible, yes.
Not just the federal story, but the Indian banking story in general. I'm going to pick up something that you said. We've gone through a phase of recovery, revival, and now you believe that for the bank, it's a phase of thrival. What does thrival classify? How would you broaden that, color that out for us? What does thrival mean for federal as well as for the Indian banking sector?
See, I think the word thrival is a play on the thrive and revival thing. But I do believe if a system which is growing well, somebody has to outpace and score extra share, it's not just one thing you do better. The whole platform and the performance level across the spectrum has to be many notches above. Right? And if federal, I do believe it's our time, can make sure that we don't, the drumbeat continues and we just don't miss a step, then the thrival theme is possible. And I think if a system is growing at 14, 15, many of our senior colleagues just spoke, over the next 4-5 years, they visualize a 15% growth. And if we are growing 18, 20, we are truly thriving. There are a few fundamental things I do believe all of us have to recalibrate. This fixation about margin. No, I'll tell you, and if you have the time, I will.
Yes, of course we do. Please do.
See, I think when the measure of margin was okay in another era, I think what everybody should recalibrate is not about margin, it's incremental interest income growth or growth. Ultimately, an institution has delivered profitability, right? High quality, credible profitability. So if the margins, very often the analyst community, this margin is lower than somebody else, but please correlate it with credit costs. Please correlate it with other surround numbers you make. And then look at the returns an organization is providing. You will find that the outcomes are a lot more sustainable. I keep obsessing about Rahul Dravid, right? And I think banking has to be like that. It has to be boring, consistent, predictable, real, all the time. The drumbeat cannot go away. And in that context, this fixation about one parameter because it served another era is probably flawed.
So what serves this era? If you believe that margins served a previous era, what will
I'll
serve
tell you,
this era as a metric?
Three things in my view. One is genuine, true improvement in productivity across the spectrum, because there's a huge amount of, and it'll perforce be required because banks don't have the luxury of space in margin. So one is efficiency has to go up materially. Second is this lip service to my credit is better than somebody else. It has to show in credit numbers. Right? If credit quality is genuinely better, if credit costs are 20, 30 basis points versus 60, 80, 90 basis points, your story changes. And the third is if 1 and 2 works, efficiency and credit costs work, you will ensure the profitability is in place. So I do think the narrative will change from pure margin fixation to growth in income, and most importantly, your credit costs are at least in the sub 30, 40 basis points if you are truly a well-run credit franchise. We are at 27.
You know, even as you hope that we move away from this maniacal obsession with margins and move to the metrics that you spoke of, but in the interim, let me ask what Lata was asking the other bankers that we just spoke to. You know, what is the expectation then as far as margins are concerned, given where we see both the cost of funds as well as the chase for deposits?
So in the near term, even the best of banks which have enjoyed high 3 or early 4 will see some compression, right, 20, 30 basis points. But if they back it up, and I do think some of the better players will, with good credit costs. See, the best banks which have margins that are around 4% have credit costs of 80, 90 basis points. So if the margin comes down to 350 and their credit cost drops to by another 25 basis points, they will match up and the profitability will sustain. So I think between 20 odd basis points, you could visualize a drop in margin. Not like a precipitous fall on day 0, but it could slide there if this war between deposits and credit growth sustains for longer periods of time.
You know, since we're talking about the future of banking and transformation, I remember that one of the first tasks that you undertook when you took over 14 years ago was to go in for an aggressive bank branch expansion. What was it, 600 branches that you opened? But then you decided to change course and you believe that it is bank light but distribution heavy. As we look at this new era of banking, what will the model be? What should the model be? What would be appropriate?
We slightly flipped that right. We had BLDH, branch light, distribution heavy. We made it light branch, heavy distribution. As in, the branch becomes much smaller, but put more people who cover the catchment. So distribution, so if you add 100 branches, like many of them said, you may not do it as 2,000-3,000 square feet. It'll probably be 500, 600 square feet, which just has a vault and a couple of people. But they have more people housed there to cover the local catchment. So I think my view is LBDH, light branch, heavy distribution, versus BLDH, branch light, heavy distribution heavy. It's shifting to light branch, heavy distribution.
So in terms of disruptions, to ensure that you remain at the table and don't become the menu, what should everybody in this room be mindful of? What are you most worried about? What keeps you up at night? Perhaps not for too long anymore, but
I have a problem.
For the next 15 days, what's going to keep you up at night?
No, I'm an insomniac, so I don't sleep much. But I'll tell you, allow me the luxury of showing off a little. I don't know how many of you were at the GFF yesterday. We introduced, and I do think it's truly world standard, you don't need a device to do your banking any longer. You walk in, show your face, pay and go. Right? We launched Smile Pay yesterday. So it's the Digi-Yatra of banking, right? So I think that's the beginning of a complete transformation of moving away from any physical device to your body. I mean, you carry that with you all the time, right? Earlier to the first time I left my mobile on the table just to tell you that my face can do the payment. I genuinely think we can do payments. So if that is happening, and this I think is a beginning, you will find that scaling up substantially over periods of time. So deviceless, and yet all the good stuff. You think and you'll bank, you see and you bank, you blink and you bank, you smile and you bank, all that is going to happen.
So what does that mean on the back end? You know, if we're talking about this era of deviceless and facial recognition and all of that, I mean, how ready you and a few of the other larger banks might be the exception, and of course the fintechs are innovating. But do you believe that we are likely to then see a significant amount of laggards in the legacy space on account of the kind of disruptions that we are seeing on the technology side?
It's only a time gap, Shireen. I'll tell you the best thing that's happened, which many of our earlier speakers said, the digital public infrastructure, the platform that is available. Yeah, if we've done it on day 0, somebody may do it on day 0 plus 180 days or 300 days. But it's not like a lifetime of change. But the point is, what we launch, we can't sit on our haunches and say we've launched SmilePay. Day after tomorrow, SBI or HDFC, which have much more client base, can do it. So we have to be on this treadmill of coming up with something else as a franchise. But as a system, I do believe this is not something that will create massive disparity. Unless they decide to just be very sanguine about being an average player, then they'll be the menu and not the table.
Well, speaking of the road ahead, I was asking Mr. Khara if he had left a note for Mr. Sethi, and he said he was part of my team, so I didn't need to leave a note for him because we jointly did what we had to do. That's not the case as far as Federal Bank is concerned. Mr. Manian has probably got the note from Mr. Vaswani or Mr. Kotak, and now he's going to have to get the note from you. So what is the note to Mr. Manian going to say?
I'm preparing a huge docket for him. We start the handover next Monday. We have a good 3-4 weeks to transition out. But he's a seasoned banker, right? I'm sure he knows it all. But I do believe connecting into our system and keep the drumbeat going and rising the tempo, he will. But I think we have a good team which will, we've had a team that's been with me for the last 7 years, the same set of senior guys. And so I think he can tap into them and build a franchise. I've told him repeatedly, listen, I don't have much of a savings. If you doubt the share price double, I'll be happier. So I'm sure he will. Please support him.
It's in your interest as well. But, I want to end by asking you for leadership lessons and what have been your life hacks that you've used successfully to get to where you have. In terms of the things that have been important to you, the red lines that you've drawn, the non-negotiables, what would you leave us with?
See, I have this bad habit of quoting many things, but since you asked me, I'll just give you 2-3 things. First is, I think I always tell myself and the team is, do whatever you can tell your mom and whatever you can tell your niece, nephew, uncle, aunt, and not be shy of. So the first is ability to, will it pass the mom test? Can you tell them mom test? I think that's genuinely an important thing in banking, particularly with a lot of youngsters coming in. So one is this. Second is just stay the course because you have no choice. Play along. Third is take your passion, make it happen. These are my 3 personal mantras, and anybody cares to listen, I keep preaching. Particularly all our younger employees, I harass them with this. But I do think in today's world, these things have greater relevance because the temptation to fraud is increasing massively. So I always tell them, do whatever you can tell your mom and not feel shy of.
Well, the mom test is going to be the crucial one that you leave us with. But, again, since we're talking about the new era of banking, and you spoke about how you believe in playing the Rahul Dravid innings, and that's what it has been like for you over the last 14 years. But do you believe in the new era in a world where we are seeing technology change so much? There's AI, there's Fintech, and there's plenty more that we perhaps don't even know of yet, that there's a need for a Kohli-Dravid innings, a merger of the two?
Yes, but those of you who don't know, I'm an obsessive cricket follower. Dravid has the best T20 run rate, even faster than many others. Second fastest 15 T20 is Dravid. So you know how Dravid can play in and out depending on the environment. So choose to be a Dravid, play the game right.
Keep playing the game right. Mr. Srinivasan, many, many thanks for joining us here. It's been an absolute pleasure. Appreciate your time. One final question. What next, by the way?
I'll tell you when I know.
Some hint. Well, any thoughts?
Nobody wants me, Shireen. I'm like, Buddha, ho gaya.
No, not at all, sir. Not at all. Age is just a number. We wish you the very best of luck. Thank you very, very much. Ladies and gentlemen, a big round of applause for Shyam Srinivasan.
Thank you, Shireen and Mr. Srinivasan, for such an enlightening chat. Shireen, I would request you to kindly present Mr. Srinivasan a token of appreciation from CNBC-TV18. Ladies and gentlemen, once again, a huge round of applause for Mr. Srinivasan for his outstanding contribution to the banking sector. Moving on to another panel discussion for the evening titled Smart Lending in the Era of Tightened Norms. The concept of smart lending has gained significant traction as institutions navigate a complex regulatory environment. The era of tightened norms present both challenges and opportunities, pushing financial entities to innovate and adapt their strategies to maintain resilience and growth. And to explore how key players in the lending sector are responding to these challenges, may I please invite CNBC-TV18's Prashant Nair to moderate the session. May I also invite the panelists for this discussion. First up is Raul Rebello, Managing Director and CEO, Mahindra Finance. Vyas Chakravarti, Managing Director and CEO, Shriram Finance. Jairam Sridharan, Managing Director, Piramal Capital and Housing Finance. And Asim Dhru, Managing Director and CEO, SBFC Finance. Over to you, Prashant.
Thanks very much, Shruti, for that. Mr. Srinivasan, fantastic chat and I mean, really enlightening and inspiring. If you're there in the room, I can't see you right now, but really lovely and inspirational sort of conversation for all of us here and big learnings. Thank you very much, gentlemen, for being here. We've heard about banks and we've sort of heard from banks about the challenges and aspirations, etc. So here is a really sort of top-notch NBFC panel. I want to say a few things before I ask them questions. The total, I was just sort of doing the numbers, the total AUM managed by these sort of four gentlemen sitting here is, I think, not worth of 4 lakh crores. You know, I want to put the pressure on Jairam straight away. Last time we did this event here, the same event, Jairam gave us a really super headline. He called out the stress in the unsecured lending segment. And of course, we ran with it. And a month and a half later, Jairam, was it? You know, the RBI came out with the regulations where they increased the risk weight for lending to NBFCs. So, I mean, I'm hoping you'll give us another one. But not just you, I mean, others as well.
मेरी काली जुबान को तुम remind मत करो यार लोगों.
No, but you know, so I want to just touch upon 2 or 3 things really on this panel. One is, of course, funding. We've heard from banks and most banks here that deposits are a problem. So if it's a problem for banks, it is a problem for NBFCs because NBFCs are wholesale funded. Second, of course, is you know what's happening to asset quality. Again, you know, FY24 exit rates on asset quality was absolutely fantastic. I think that number, 2.8% system-wide NPAs, I mean, the lowest ever. So there is a bit of cyclicality. It should go up, but I mean, are there other issues involved as well? And the third sort of aspect I want to touch upon is regulatory action on the record, mostly here. So let's kick it off. Mr. Chakravarti, why don't I start with you? Is funding going to be a problem for NBFCs? I mean, if you look at FY24 and bank advances, it was what 22 odd lakh crores. If you look at estimates for what the overall system credit will be in FY25, it's expected to be lower than what, I mean, in terms of absolute net sort of credit of the banking system. So in that sense, there is less water in the lake expected to be. What does it mean for NBFCs like yourselves and others?
I don't know. So far, whatever I've seen, the banking sector has not slowed down their lending to NBFCs as of today. So I'm not sure going forward whether it will happen. But one thing for certain is the smaller NBFCs are finding it difficult to raise resources, which is very unfortunate. One point. The other point is, again, as I said, deposits. I mean, we have a deposit taking license, but our deposit is growing at around 20%. Most of the private sector, I mean NBFCs who have a deposit taking license, their deposits are growing. But the other side also, I don't think, I mean, I'm sure my colleagues here also will support that we do not see any overt pressure on liquidity as of now. But fact is, the smaller NBFCs, yes, they are finding it difficult to raise.
Got it. Jairam, you want to weigh in? What are your thoughts?
See, I think Mr. Chakravarti and many others are blessed to have deposits as a source of funding. अब तुम अमीर आदमी को इन्फ्लेशन के बारे में पूछोगे तो वो तुम्हें क्या बताएंगे? हमसे पूछो. there is not a challenge in terms of availability of money, but there is a pricing pressure. The fact that liquidity is low in the market has essentially led to banks essentially saying, इतना रुपया आपको लोन दे रहे हैं, ये रेट है, take it or leave it. पहले जो negotiation possible थी कि भाई, I'm borrowing from another lender at X price, so I'm going to negotiate down to that X price, etc. The bank now says, boss, this is the price. You either take it or you can walk, because I've got only so much limit of how much I can lend to NBFCs, and utne ke liye to log line mein lage hue hain, right? So it is, I think, a pricing pressure right now. Lata earlier was asking the question on margins, and what Mr. Vaswani said about long term kind of, things all look bright, and of course in India long term hamesha bright hota hai hamara. But in the short term, there is no doubt that the deposit crunch leads to margin pressures across the system. Mathematically, there's just no other way, for it to not happen. It will show up differently. The economy is a caterpillar. Some places will be compressed and some places will be elongated. And it will show up in different places. Right now, from an NBFC perspective, that is showing up as margin compression. And you saw some of that in the first quarter results. You'll see more of it in the second quarter results. And I think it is something that we need to be aware of. But availability of money for the medium or large guys is not a problem. The smaller guys are really struggling in terms of access. The really small guys are really struggling. You're seeing that in Fintech NBFCs. You did not hear that in the GFF. Right?
We have a Fintech panel next, so you probably will hear some of it.
Please ask them. There is all the fanfare aside, from an actual lending perspective, Fintech lending has significantly decreased over the last year. There's no doubt about it. And while credit risk issues are one part of it, liquidity is also a driving factor there.
Just to add to that, I think one positive for the small finance companies is one of the senior banker from a public sector was telling me, why would I lend to you? I'll get a good rate, so I would prefer to lend to smaller finance companies. So there is also that side, the bankers are also looking at better margins if they lend.
But in any case, there is margin pressure. I mean, for those smaller guys then, right? I mean, at some, it shows up.
Definitely.
Aseem, you want to weigh in? I mean, your thoughts?
So to take the early analogy forward, that these gentlemen are on the table, I am the one in the menu. So if you actually see this structurally, 40 trillion is the total borrowing that NBFCs and HFCs do from the system, of which about 55% comes from the banking system, 45% comes outside. Of that 45%, 12% comes from pension funds, etc. About 13% comes from insurance companies, and about 8% comes from mutual funds. So already 45% of borrowing, and then 6% comes from ECB. So these are the broad sources of borrowing. Now, we have to see that if you are rated AA and above, then entire 100 is your menu. If you are rated below AA, then your menu is that 55% bank, because the NCD market is not really open to you. ECB is out of question. So, I mean, how is the world? It's an elephant story, a blind man and elephant story. It will appear very different depending on who you ask and what is the view from that point of view. So yes, in short, I would agree from what both Jairam and Mr. Chakravarti said, that it is not availability of credit that is an issue. The cost of credit is going to be an issue.
But some of the larger guys have also raised ECB money, right? I mean, so that is also happening. So availability is there,
not available to below AA rated companies.
See, of all the instruments that are available for an NBFC to borrow, a AAA has access to all of them. A AA plus has access to maybe a tiny bit less, and A has access to a little bit less. For example, as a AA player, I cannot access at size, I cannot access the domestic bond market, right? Because it's just not open. But a AAA guy can. Now, but I can still go and do an ECB. Below a AA, even that option is a little bit less. And so on. So number of instruments available become lesser and lesser, and you get more and more dependent on banks as you go down the size. I think is the point that Aseem is making.
Rahul, please weigh in first thoughts. Has it been an issue for you at all, what we're talking about, or no, not yet?
So since Jairam talked about blessings, I should show some gratitude here. Yeah, we have a deposit-taking license. We are AAA rated. And we also have something which today everyone is hungry for, which is priority sector. Right? So you add these three up and I can't complain. But it's important to be diversified. As bankers and lenders, you want to be diversified on the asset side. But especially at our shop, we have not had a very good deposit franchise. So a lot of my time goes in not just looking at cost of funds, but how granular your liability book is. So there's going to be margin pressure. I'm sure we're all seeing that. But otherwise, I can't complain too much on this stage.
Where are we? I mean, Jairam, you said that it's already showed up in the first quarter. So, I mean, are we early in and we'll see a lot more of it? I mean, is there any way to tell at this point?
I don't know. My guess is that Q2, there's a lot of AUM here, so I shouldn't say things which are proven wrong very quickly. But I do feel like Q2 is going to be the bottom from a margin perspective. Things should start looking up. A lot depends on what happens in the policy environment, and if some easing starts happening, and how long it takes for that easing to start showing up in lending rates. But see, the liquidity was way tighter 2 months ago than it is now, and hopefully it stays that way. Hopefully, I mean, it's not an excess liquidity environment, but it's not a very deficit liquidity environment either out there. So hopefully things stay that way for a little bit longer for pricing pressures to ease. And if regulatory action happens, we saw what the Fed said recently. So hopefully that translates into some action on the RBI front as well. And if it does, you might start seeing some easing on that situation from Q3 and beyond. But Q2 does not look like it's going to be, it's going to see any improvement if it's going to go further down.
I mean, it's predicated on a Fed cut, then RBI is starting to ease, basically, right?
I wouldn't say the then in between. I mean, RBI might do things before the Fed does. But yes, there is obviously a close correlation between the two things. Yeah.
Got that. Let's talk about the other sort of part of the conversation, which is asset quality. Again, we exited F524, absolute pristine asset quality, not just banks, but NBFCs as well. Q1, we started to see some stress. Where are we and what are we seeing really, Mr. Chakravarti? Because, I mean, you have your, you operate in many segments now. You're not just a truck financier. You have, you operate in practically all segments. So what are you seeing?
Actually, if you look at the market-wise, whatever stress we have seen, a little stress, is in the urban markets. The rural and semi-urban, most of the business are performing well. The products that we are into are performing well. We have seen a little stress in this SMEs, particularly small and micro businesses in the urban environment. But otherwise, in fact, the first quarter we've done, touch wood, we have done well. And so far, second quarter is, we are in line with what we have done, numbers in the first quarter. So basically, the urban environment is something there where I'm seeing a little stress, but not on the rural side.
Rahul, you would agree with that? You have a fair bit of sort of rural exposure as well. What's your sense? Is that holding up well, or are you seeing some stress there?
See, the customer segment, which is depending on one source of income, that definitely sees some more stress. So, quarter one versus Q4, you have seen everyone go up a bit. If you look at those customer segments, were totally kind of their fortunes were linked to the agri income. Yes, they were slightly more stressed, at least for what we saw, and tractors see some kind of jump in the first quarter. But I think at a headline item, I don't think there's any alarm bells ringing, because we had two crises in the past, and I think at a household level, what we see is inherently households have tried to diversify their household income. If there are 2-3 generations, they're trying to even up the game in terms of their overall resilience. So I don't think alarm bells at all. But yes, there was a slight blip in some segments. And see, quarter one, typically for a player like us, we have 85% upwards of self-employed non-professionals, right? And the elections did cause some bit of a disruption, and we had some extreme heat waves, and in the east some early rains. So Q1 typically has some disruptions, but I don't think we can call the rest of the year right now.
There was an analyst who we spoke to recently. He counted, I mean, I think his team counted the number of times elections and heat waves were mentioned on earnings con calls. And it was, but yeah, we've heard that.
Always mention things that can't be measured.
But Asim, you wrote a post recently, and that went pretty viral, talking about sort of the crowding in on retail, because corporate lending is not really, the only game in town is retail, and how that perhaps raises risks. So just sort of explain that point in the context of asset quality and what you're seeing.
See, trouble with averages is that you can drown in an average 4 feet of water. So the problem is that we have not yet accepted the fact that post-COVID the K-curve recovery is very real. And what has happened is that while some of the people have done very well on the upward end of the curve, a large part of our population is battling inflation. And what has happened is that incomes have not really kept pace, and lifestyle expectations have changed. So to fill the gap, people have excess credit to fill that gap between the life they want to live and the life that they actually can afford to live. If you look at what happens is that look at what is the total record CIBIL has. About 145 trillion is the total borrowing that people have done on the consumer side at a consolidated level. Now, if you see what happens is that there are about 8 crore people in the country who file a return. 3 crore people pay any form of tax, and about 45% of the tax comes from just 1 crore people. So that's the math. Now, who do you think the entire 145 crore lending majority is going towards? You take out the 3 trillion lending that happens on microfinance. You take out some amount of SMEs, commercial vehicles, all of that at the bottom end. A large part of the lending happens to this taxpayer community, because banks generally lend to that community. So effectively what is happening is that there's the layering happening. Now if you look at microfinance, for example, the latest Pulse SIDBI report basically states on the first page that the AUM of the industry has gone up by 22% and number of customers has gone up by 6%. So effectively when you do the math, it clearly tells you that we have possibly, the party has got extended a little too late, and there is going to be a little bit of a bill coming. We have gone to one extreme of credit quality, and now we will swing a little. I don't think that there is cause of panic. I don't think that people need to really read too much into it. But have we really, from here, do we really see a 10-20 basis point increase in credit cost? Possibly yes.
But no blowout in that sense. I mean, just a.
No. So see, one of the good things that between us and the regulator, it is like the dog and the vet. The dog will complain even if the vet is doing what's right for the dog. But the reality is that they have made the system safer. So whatever were the bubbles that were identified, so for the first time, see, as a banker, when I wear my previous hat, for the first time in the system, I do not really find excesses and I do not find risk. If I was a lender to NBFCs at this point of time, I would not be losing any night's sleep. So the system has become a lot more safer. And if you look at capitalization, every lender today is beautifully capitalized. Leverage level is probably at its lowest ever. So when people are making good return on assets, good return on equity, on low leverage, and great capital, I don't think there is a systemic risk. It is just that when it hits, a few players may have to take a little bit of adjustment, and it is always it's a tripod. You are balancing growth, you are balancing ROAs, and you are balancing asset quality. So in this tripod, sometimes last year was the time it was perfect. It cannot be perfect. I mean, last 10 matches, Tendulkar has scored a century. What is the probability of what happens from here on?
Yeah. No, absolutely. A point taken, well explained. Jairam, on asset quality, what are you seeing? On the consumer lending side especially.
Yeah, so let me take one of the points that Asim made. Let me just try and take it forward. This point about leverage. I think leverage is a real issue in the market. Here are two statistics that kind of stun me, honestly. Of all the applicants for credit, unsecured credit in the market, 10% have more than 10 live unsecured loans right now. Of all applicants, 10% of them have more than 10 live unsecured loans. How crazy is that? Who would have thought that anybody would be running 10 unsecured loans? 10% of the applicant population is running that today. Here's another statistic. Everybody who's applying for digital loans, right? You should ask this at the Fintech panel next. Everybody who's applying for digital loans, 50% of those applicants have more than 5 unsecured loans open. 50%. This is not normal. This is not the way lending works. This has not always been the case. It is new. Something new is happening in front of us right now. Now, of course, people will argue out that these are not really loans. These are small, kind of this BNPL type stuff. That's not really lending. That's just payments, shush. But we don't know how this works. So what we are seeing today in terms of absolute levels of leverage are not good. When you look at it from a historical context. Now, having said that, the numbers, when you look at pure delinquency numbers, etc., they have ticked up a little bit from when we last spoke, but really nothing has really blown out. It doesn't look like a big impending doom has come in. However, one needs to wonder how much is that related to this high leverage problem. The fact that people have so many lines open. I don't know how much of that line is actually going to pay some other line in the previous credit that you just opened. So you asked kind of, or in the previous panel as well, there was this question about kind of where are we headed, and I think Lata asked the question, is the best behind us, or is the peak behind us, or something like that. I think the best in terms of asset quality is almost certainly behind us. There is no doubt that things, or tomorrow is going to be worse than today. Now, how much worse, and we don't know. But the fact that this year is going to be worse than last year, I don't think people would disagree, or certainly the numbers won't disagree. You will start seeing the numbers, and you're seeing some already. So that's broadly where I stand. I do not think I do agree with Asim's point that there is nothing that indicates a big blowout yet, right? Because the problem is happening in a segment of the population which is 8-9% of the entire segment. If you dig deeper, even smaller. But the fact that there is a leverage problem in the industry, in my mind, is unquestioned.
And is the guy with the 10 loans getting the 11th loan, and the person with the 5th loan getting the 6th loan, or no?
That's the applicant pool. Thankfully, the disbursed pool actually looks a little bit different. So it does look like somehow the credit criteria of lenders is catching some of this, and is giving the highly levered people slightly less credit, but it's not zero. So that proportion of 10 plus is not becoming kind of much lower anytime soon. I will say though, and there is something to your question, I will say that if you look at that same number 3 quarters ago, that number was even higher. Right? So there is a downward trend in that high leverage number, because I think more people are realizing that there is a leverage problem. But in absolute terms, it's still a very high number.
Got it. Let's, Asim, you want to add something?
Also, Prashant, one thing you have to keep in mind that हमारी हालत ये है कि काजी दुबले क्यों पूरे गांव की चिंता.
Sorry, repeat that.
काजी दुबले क्यों है पूरे गांव की चिंता. So the reality is that because you are standing from a point of vantage where you are looking at the entire economy and various constituents, you are always more worried than the borrower about the borrower's ability to keep paying you over time. So in a way, it is good if we are worried. If we are not worried, then all of you should be very worried.
Oh, that's very well said. One quick round on the last sort of bit that I wanted to touch upon, which is the regulator. And, their actions have been widely appreciated. They've been putting out fires. We've heard that before sort of they spread. I just wanted your thoughts. I mean, what would you like to see? I don't think we have the regulator in the room, not anymore, but so maybe you guys can be on the record a little more. Rahul, you want to start? What would you...
Yes, let's talk about the regulator on camera. That would be fun.
Go on, Rahul.
Yeah, can you switch off the cameras and recording now, please? Well, I think the three big things, the scale-based regulation which applies to 16 of us, significantly kind of takes the compliance levels, and I think there's no more arbitrage between us and a bank anymore, which is good. I don't think we need to complain there. It just helps us sleep better at night, know that there's more stability, and the control functions step up is pretty significant. I think so. No complaints there. For someone like us who's been typically a traditional lender, single line, and now trying to diversify, I think facts that the whole digital lending guidelines have come in and made it much more predictable and set the rule book in place again is pretty good. The third big thing, if I were to look at, is the whole risk weights. Yes, we talked about it. It does have it has an impact on the quantum of funding and margins. But overall, I don't really, at least you'll have different answers from all of us here, but from our vantage position, it's not something that we could complain about.
Asim? I'm not looking for complaints. I'm just looking for feedback and
See, financial sector are naughty fellows. So if we are given freedom, we will tend to, in the pursuit of profit, overstep boundaries. That is the nature of the beast. In fact, I would highly recommend a book called All the Devils Are Here. In case anybody has not read it, please read that book. It is about how the US system arrived at what it did and what the players were up to. It was fantastic. There the entire regulation fell behind the curve, and the innovation went way ahead. Here, at least one thing we can't complain, that the regulator is actually ahead of the curve, and we are trying to keep pace. So we may complain, but for the system, it is very good.
I mean, you gave the example of the dog and the vet earlier. I think that's something. Jairam, you want to quickly weigh in?
I agree with most of the points that Rahul and Asim said. I do think the regulator has been forward-looking and appropriately conservative in different pockets. They do end up sometimes getting the wrong end of the stick, as we heard from Mr. Swaminathan earlier today, in terms of being deemed a little bit trigger happy was the word he used. So there is a little bit of that you hear. That's. Anybody on whom you take an action is always going to complain about that. So it's not there's not a whole lot you can do on that score. What I think the regulator has slowly been moving towards, and we would love to see a lot more of as well, is more sort of principles around which regulations operate, and sort of prescriptions, which have been the way that a lot of regulatory guidelines have worked in the past. Maybe the sector is getting to a point of maturity where we can move a little bit further away from highly prescriptive towards a more principles-based regulatory environment.
Gentlemen, I wish we could go on, but we're completely out of time. Thank you very much, all of you, for being here. We have our next session ready. Mr. Chakrabarti, Jairam, Asim, and Rahul, appreciate you being here on the panel. Thanks very much. Thank you.
Thank you, Prashant, and thank you, panelists, for sharing your valuable insights. Thank you so much for joining us here. Moving on, as India sets its sights on achieving the monumental goal of a $10 trillion economy, the financial sector stands as both a cornerstone and a catalyst for this ambitious vision. And to shed light on the evolving landscape of India's financial sector, please join me in welcoming V. Anantha Nageswaran, the Chief Economic Advisor, Government of India. Ladies and gentlemen, despite his busy schedule, he's joining us virtually from Delhi. Welcome, sir. Over to you, Shireen.
Thank you very much, Shruti. Chief Economic Advisor, thank you so much for joining us here this evening. We've got a packed audience here in Mumbai, and we were hoping to have you join us in person, but we understand that the GDP print is a much more significant event to deal with. So let's get started with that, sir. The number coming in at 6.7%, a tad below the CNBC-TV18 poll of 6.8%. For the benefit of our audience who are here in the room and those who are watching, explain to us whether this is materially the election impact that's played out on the GDP print, and whether you believe that growth continues to be robust going forward.
Thank you, Shireen. First of all, I would have also very much liked to be there, and therefore my apologies for not being there, and also my sincere thanks for you and the organizers to accommodate me to be able to participate in a virtual mode. Regarding the GDP print, I think first of all the good news is that there is an alignment between the production side and the demand side, and most components of the demand side have held up very well and have expanded compared to the first quarter of last year. And as you said, yes, the election season might have had a hand in it, because government final consumption expenditure as well as and also gross fixed capital formation would have probably moderated in the first quarter compared to the previous quarter, leading to this, compared to the previous year's first quarter, leading to the slight slowdown in the growth rate. But as I mentioned in my press conference that concluded a little while ago, I think the broad momentum of the economy remains very intact, and I think we do expect that with the monsoon having been good so far, hopefully it doesn't turn out to be too much of a good thing. I think we can look forward to gradual improvement in the GDP prints in the coming quarters.
You spoke about the fact that we should expect a gradual improvement. 7%, is that the expectation now on a sustainable basis, CA? And also, you talked about the monsoons. That was one of the red flags that you'd highlighted at the time of the presentation of the economic survey as well as the budget. But that concern is less of a concern today, and that's the indication that we get from industry as well. And you kind of alluded to that. If that's less of a concern today, is there something else that's overtaken monsoons in terms of concerns?
So sorry, I just didn't hear which concern of the various risk factors that I highlighted during the economic survey presentation.
The monsoons, sir.
Which one you're referring to?
The monsoons.
Yeah. So thank you, Shireen, for clarifying that. I think monsoon deficit is no longer a concern. If anything, as a news report in today's Business Standard points out, if monsoon were to overstay its welcome, and in terms of first of all, we now know that deficit monsoon divisions, out of 36 monsoon subdivisions, the deficit divisions have become very, very few in number. And there is a large number of monsoon divisions which have had a normal rainfall, which is plus or minus 19% of the long-term average. And that's a good thing. But there are also quite a few subdivisions that have experienced excess and a very few large excess. I think if, as we head towards late September, October, if the monsoon is still active, that might have some spillover effects on the harvest of the kharif crop. So that we need to watch out for. But at the moment, the good news is that the reservoir levels are much higher than last year's, as well as the average of the last 10 years. So that's a good thing. So I must say, therefore, on balance, the concerns with respect to monsoon have probably subsided than what it was when I made the presentation during the economic survey. But nonetheless, I think we are comfortable at this point here in Delhi to maintain the fact that our expectation for the full year's growth will be between 6.5% and 7%, and we don't intend to make any change at this point. We'll wait to see some more data for the second quarter before we can form a more definitive view on where the final outcome might end up edging towards or leaning towards.
You said the deficiency of the monsoon is less of a concern today. So let me address some of the concerns that you might be thinking of today. And you kind of alluded to that in the North Block's monthly economic report that is released. And that's based on what the RBI surveys are suggesting, both in terms of consumer confidence as well as manufacturing. Any rising concerns on both?
Yeah. No, not rising concerns, and I think the fact that the consumer confidence headline index declined, and also we saw perceptions on employment from consumer side, which had improved very steadily from the very low levels reached during the COVID pandemic, had shown constant improvement, and we would have liked to see that head into positive territory. But I think the consumer sentiment on employment, consumer perceptions rather on employment turned negative, and it was a negative in the June survey of the central bank. of consumer confidence and in the August survey as well. Of course, it is not necessarily the case, therefore, that there is less optimism on jobs per se. It may well be the case that there is less optimism on the kind of jobs that people are looking for and therefore the kind of jobs that they were getting. Hopefully, the budget's various incentives on job creation in several sectors, particularly focused on manufacturing, will bring consumer perception on employment back to positive territory. So that is one area of concern, and also the industrial outlook, because I think while capacity utilization is very high, and we saw in the first quarter GDP data that private consumption is holding up quite well. Nonetheless, there are concerns in the industry about dumping, about excess capacity in China, for example, and that might also make them a bit cautious going forward about production, accumulation of inventory, and their capital expenditure plans. So in that sense, it was quite heartening to see the RBI monthly bulletin of August, which shows that private sector has been raising money, has good spending plans with investments in the next several years. So hopefully both these indicators are temporary and short-lived rather than harbingers of a trend. Back to you.
You talked about the fact that we are probably seeing dumping on account of the excess capacity in a market like China, and that potentially is impacting sectors back home in India. Do you believe it is time for further intervention? We do see the government regularly intervene by way of duties and so on and so forth, but do you believe that there is a case for intervention, and if yes, in any specific sectors that you believe have been identified or on the watch list today?
So Shireen, I must say that the audio is a little bit on the lower side. I don't hear everything very clearly, what you are saying. But nonetheless, I think if I'm not mistaken, you alluded to the question whether we have identified which sectors are particularly vulnerable to this issue of excess capacity and dumping. Was correct, that the question?
That's correct. And if you believe that intervention by the government is warranted today.
Okay. That is difficult for me to say. It's premature at this stage, and I think the exercises are going on, and I'm sure the industry will also be giving its feedback. And therefore, it is not fair on my part to comment whether at this stage there is a particular action that is warranted. But we should be aware that the last time when we had a non-performing asset cycle in India between 2012 and 2018 or 19, apart from many factors, one of the causal factors was post-2008 financial crisis, disappointment in global growth, and the stimulus that China gave post-2008 crisis also led to massive excess capacity and dumping of steel, for example, which had an impact on global steel prices, resulting in distress in several steel companies in India. That is sort of a memory from the past that we should not forget, because the implications of this may well go beyond capital formation, inventory accumulation, slower GDP growth. We also want the current financial cycle in the country to last longer, and therefore we need to examine this phenomena from multiple angles.
Well, since we're talking about trends that we need to factor in as an economy and as a country, the big topic of debate here at the Banking Transformation Summit (CEA) is the issue of deposit growth and deposit mobilization, and what that means for India's banking sector. And this is something that the survey also talked about as a potential cause of risk. And the move that we've seen towards the capital markets, for instance. In that context, I want to also bring up something that you tried to dispel, that the fall in household savings was not a sign of distress, but was a sign of diversification. So how do you see this playing out in the long term, and what are the implications for India's banking sector as we see this challenge of deposit mobilization and deposit growth?
No, I think I have very little to add to the excellent articles that have appeared from several of my friends in the industry, and including by Vivek Kaul in Mint today. on the misunderstanding and the misperceptions on deposit growth and credit growth, and Vivek correctly refers to the Bank of England paper published in 2014 that loans create deposits, and even if investors are the public is shifting to capital markets, I think the money eventually comes back into the banking system as deposits. So I think it has different causal factors. I don't think the inclination of Indian public to save via the capital markets is the reason for low deposit growth, because then one needs to look at money creation in general having a role in deposits growth. So I think this is not the right framework to examine the widening gap between credit growth and deposit growth. Now, as far as the household savings are concerned, in fact, not only the case that households have been diversifying and from financial assets to real assets, it is also the case that our measurement of financial savings may be on the underestimation side. I think right now the capital market regulator and the central bank are engaged in an exercise of looking at it and seeing whether we are capturing all the primary and secondary market investments, mutual funds, single stock investments that Indian public is making in our overall measurement of financial savings. So the issue that has been flagged may very well lie in the inadequate capture of the data rather than a real problem with household financial savings.
Okay, point taken.
Back to you.
Point taken, sir. Let me address the other point of debate here at the summit, and that is whether we've peaked or the best is behind us as far as the banking sector performance is concerned. At least for now, we've had a stellar last few years, particularly the last year has been a record-breaking year on many fronts. Of course, banks find themselves very well capitalized at this point in time, so that balance sheet problem has largely been addressed over the last few years. How do you read the trends, the signs? Does the government have a view on whether there is likely to be a deterioration in asset quality? And is there a view within government on what the next few years could look like for Indian banking?
No, I don't think there is any concern at this point about deterioration in asset quality in Indian banking. The regulator, Central Reserve Bank of India, has been doing a very good job of keeping on top of it. As we saw a few months ago, or rather towards the end of 2023, the preemptive measure they took on increasing risk weights on unsecured lending, etc. I think, and also the deployment of technology and to flag rising concerns. So I don't think there is any concern here about the asset quality deterioration. Nonetheless, of course, you pointed to the fact that banking sector performance was very good up until the financial year FY24. Therefore, naturally, given that the base has gone up quite considerably since the difficult days of the mid-2010 to 2020 period, it is natural that the growth rate moderates. And that's a good thing, because we want the financial cycle to be stronger for longer. And in fact, if there is a moderation in the net interest margin of the banking system as a whole, it isn't a bad thing, because we have seen, for example, in the United States pre-2008, when the financial sector performance or its market capitalization in the overall market cap rises much faster, it actually is a sign of imbalance rather than a sign of health in the overall macroeconomy. So some moderation and at the same time continued healthy growth isn't a bad thing. As far as the medium term is concerned, I think we do need to look at, given the investment needs of this country, both for normal infrastructure investment and climate-related infrastructure investment, and also for replacement demand, what is the level of savings and how can that be generated through income and employment growth, and how will the savings be intermediated through through capital markets and through the banking system? What should be the right debt to equity mix, and given that, what should be the size of the banking system in the country? Do we have enough number of banks? And why is it that we don't have a global bank that caters to Indian industries, investment interests overseas? Because many countries, whenever their industry went into another country, their financial institutions also followed suit. But for example, the Indian industries' overseas banking needs are still met by multinational banking industry. So these are all the questions that we need to contemplate, apart from the fact that the induction of technology should actually be geared towards making banking easier for our consumers other than more complicated. Because although the Indian demographic dividend is very strong, the aging population will catch up with us as we head into the mid-2030s onwards, and therefore making it more and more technology intensive will also make banking more and more difficult for our households. So we need to strike the right balance between technology, safety, security, and ease of use for the Indian public, and also with respect to employment generation, the application of artificial intelligence, etc., because banking industry is something that operates on trust, and people do associate trust with the human interaction. So those are all the questions that the industry need to contemplate for the medium term as far as Indian banking is concerned.
Since we're talking about contemplating questions for the medium term, sir, let me ask you about the journey that we've seen, and we've just clocked that 10-year milestone as far as the Jan Dhan accounts are concerned. CA, what do you believe the next phase of evolution needs to be when we talk about Jan Dhan accounts? Because while we've done a fabulous job in opening these mammoth no-frills bank accounts, but the fact of the matter is that we still have about almost 8.4% of the accounts, which is about 4 crore accounts, which are still zero balance. And anyway, these are meant to be zero balance accounts, but also inoperative banks, about 10.6 crore are inoperative accounts at this point in time. So as we move beyond this 10-year milestone that we've clocked, what do you see as the next phase as far as the Jan Dhan accounts are concerned?
Shireen, even if we are able to show that not the glass being half full, but 3/4 of the glass is half full, you are saying that the 1/4 of the glass is empty. I mean, that is a bit harsh and unfair.
No, that's not my intention at all. That's not my intention at all. I'm merely asking this in the context of the next 10 years. Now that we've opened these accounts, the next 10 years, what should the priority be?
Look, at the end of the day, I think these accounts are starting points, and then whether it leads to greater financial access for resources for growth, and ultimately the financial sector grows when there is employment generation, income growth, and savings rises. So therefore, the next set of growth for Indian public has to be to achieve the right kind of balance in their portfolio between financial and real assets, and also have a high sense of financial literacy. And more importantly, the concept of insurance is something I think that needs to grow along with the spread in banking. So these are all the next steps that we need to contemplate as the Indian public overall achieves a higher level of financial inclusion than we have seen in the previous decade. So I would expect that these are the next milestones or areas of attention from the policymakers, from the industry and regulators, etc.
Sir, speaking of the next milestones, something that is much more immediate, of course, is the base year revisions, both as far as GDP and CPI are concerned. When can we expect that, and do you have a view on what those should be?
I don't have a timeline at this point to share with you, but I'm aware that the Ministry of Statistics is very much actively engaged in the process of addressing not only the base years, but the constituents and the weights of various indices, and then leading to GDP base year, etc. And the 7th economic census, index of industrial production, also looking at launching producer price index series, revising the consumer price index. All those exercises are very much underway. Perhaps you should have a conversation with the Secretary, Ministry of Statistics.
We will try our luck with that as well. My final question, CA, before we let you go, let's talk about the global environment. We've, of course, just seen the Fed chief speak at the Jackson Hole Summit. We've had the MPC minutes come out as well. One on the commentary that's come in from the Fed, what do you make of that as far as the global interest rate trajectory is concerned, and what did you make of the MPC minutes as well?
Shireen, I have never commented on the monetary policy stance in India in public, and I'm not going to mar that record now. As far as the Federal Reserve is concerned, I think it will be presumptuous on our part to tell them what they should be doing or what they ought to be doing. But I think it does look like the Federal Reserve, and even today as we speak, the personal consumption expenditure price index data have come in on the lower side. At the same time, we had the GDP data for the April to June quarter was revised higher. Of course, one can always say that that is a historical data. And looking ahead, I think there has been a certain softening of employment figures and softening of the inflation figures as well in that country. Maybe the financial markets, rather than commenting on what the Fed will be doing or what they ought to be doing, what I do feel, however, is that the financial markets may be discounting rather aggressive and faster pace of rate reduction on the part of the Federal Reserve than what they may actually do. This is just my guess at this point, wearing the hat of a capital market participant from a different era, from an earlier era.
Well, since we're talking about era, sir, my final note to end this conversation on, we're talking about the future of banking and how we expect banking to transform the country and transform itself as well. What would be the pillars of transformation that you believe the banking sector needs to prioritize and really to be able to achieve that $10 trillion aspiration, which is the more immediate aspiration? Do you believe the Indian banking system is geared to deliver for that?
I think the Indian banking system as a whole, that includes the industry participants, the regulators, etc., need to tailor their approaches to the Indian context. We need to be aware that some of the principles and practices we import from overseas may not necessarily suit the context of a developing country where many small and medium enterprises still do lack access to finance. So whether it is in insisting on certain external credit ratings, some of these things were flagged by the Honorable Finance Minister in the budget speech as well, classification of accounts into special mention accounts, SMA 0, 1, 2, etc., and what they actually do during this period to nurse the accounts back to good health, and therefore access to credit is extremely important aspect. And second, at the same time, the low-hanging fruits of credit are always about personal or consumer loans. But there again, I think the banking industry should be mindful of the fact that one should not kill the goose that lays the golden eggs, that is over-lending, or for that matter, over-borrowing on the part of the financial sector or the part of the household sector will eventually prove detrimental as the financial cycle will enter into a prolonged downturn, as we saw in several countries in East Asia and probably are seeing in China at the moment, for example, or for that matter in advanced countries post-2008. In other words, I think one important behavioral aspect that the industry has to keep in mind is moderation in terms of growth and in terms of credit culture will stand India in good stead, and also ensuring that whatever we do, we tailor it to the Indian context and the fact that we are a low-income aspirational country wanting to become a middle-income status. We need to sustain our growth rates, whether it is economic growth or credit growth. So whatever that needs to be done to sustain them, and that includes delayed gratification on the part of the banking industry and the non-banking industry, Those would be my ideas or priorities for the banking industry for the medium term. Back to you.
Thank you so much. I know it's been a very, very busy day for you, but we truly appreciate you taking the time out to speak with us here today and address the gathering of bankers, NBFCs, Fintechs, and policymakers here at the CNBC-TV18 Banking Transformation Summit. We truly appreciate your time, and thank you very much for leaving us with that thought of the Indian banking sector playing a Rahul Dravid-like innings. We truly appreciate your time. Thank you very much. Ladies and gentlemen, a big round of applause for the Chief Economic Advisor, V. Anantha Nageshwaran.
Thank you so much, Mr. Anantha and Shireen, for that insightful conversation. Moving on, in the ever-evolving landscape of financial technology, digital lending stands out as a transformative force, reshaping how credit is delivered and experienced across diverse markets. Now, as we navigate this new age, innovation and adaptability are crucial in harnessing the full potential of digital lending. The next session, titled Transforming to New Age Digital Lending, Innovations and Opportunities, will delve into the latest technological innovations, the challenges and opportunities in digital lending. And to moderate this session, may I please invite CNBC TV18's Ritu Singh to come up on stage. Joining her for the discussion is a leader whose career is a testament to innovation and strategic foresight in the financial technology sector. He's been a pioneering force in transforming digital lending. Please join me in welcoming Vishnu Ardusad, Managing Director and Co-founder, Nucleus Software. Over to you, Ritu.
Thank you, Shruti. Well, Mr. Dusad, thank you very much for being here with us. You know, the topic of this conversation very much is transforming into a new era of digital lending. And we know that the core of this digital transformation is technology. And that is what you at Nucleus Software are doing, providing that technology backbone to the banking industry. Let me just begin by asking you, because we know the importance of technology and the regulators' repeated, sort of encouragement to banks to invest more and more. What do you make of the state of especially legacy banks in terms of their adoption of technology? Has it lagged? Has it improved? What is the pace at which it is growing?
Very meaningful question. I think over a period, most of the banks have adopted to the state-of-the-art technology. Some of them have been ahead, some of them have been behind the curve, but they have by and large adopted. But having said that, already the technology innovation is at such a pace that the players do fall behind. And that is where there is an opportunity in terms of catching up with the latest and delivering far higher value to the customers and to the society by adopting the latest.
Well, if you could highlight for us, especially for legacy banks, which we were alluding to earlier, for them to transform into this new age digital lenders to compete with the much nimbler, faster fintech players that are emerging in the ecosystem by the second, I would say. What are the challenges that they're facing in this kind of transformation, and how are you helping them, achieve that?
I think the biggest challenge that they face is understanding what technology can do and cannot do. And that's where we are able to help them understand this tool, so to say, to do their business in an effective manner. And through our processes, through our sales process for that matter, we are able to get across to them the power of technology that delivers loans within seconds. We've seen legacy era of personal loans getting delivered in months, then weeks, then days, and hours, and now we're talking about seconds. Yeah. So that's what we explain them, how data-based lending can make things happen at a different pace. And when they start understanding this, they are able to make things happen.
Well, that's exactly what the CEA was warning us about, this instant gratification and the need to, over-leverage. But, since you brought up data use, a lot of the lending, especially by fintechs, focused and, leveraging the data available in the context of what the policy is bringing about with the Digital Personal Data Protection Bill. Just to allude to that, with the kind of consent infrastructure that banks would have to create, for each loan they kind of give, what sort of recalibration in business models would this require, depending on, of course, what the final rules say?
That's a very interesting question. I think this was something that was long overdue because personal data protection is something very, very important. We have allowed our data to go out for almost a decade now. But now, thankfully, the Act is here and hopefully the rules would also be here soon. So I think banks and NBFCs would have to look at data in a completely different manner. Their approach to usage of data, their approach to capture of data, usage of data, and storage of data will undergo a drastic change. Of course, data has been oil for now, a decade or so. So that importance will continue, but it will in fact increase further so that no individual feels that they are getting cheated.
So, would this require some kind of recalibration in the lending models itself?
No, I don't think that should be too much of recalibration on that front. What is important is you need to make sure that data is not put to misuse or abuse. And that's about it. And that we would, the banking industry would be able to achieve via policies which are going to be ensuring that it is not allowed to fall in the wrong hands. That is what is most important.
Well, speaking of, data falling in the wrong hands, digital lending and the threats associated with it, they really go hand in hand. As the industry is undergoing this digital transformation, threat of, data privacy, cybersecurity is also emerging. In fact, this morning we had the Prime Minister say, when you talk about legacy banks, there'd be some event that happens that negatively affects them, and then the news travels, and then, there's a run on the bank. It takes a while, for the banking business to be disrupted, whereas in the case of fintechs, as you understand, one data breach could result in the death of a company within a day. So, in that context, how are companies like you helping solve for this? How are you staying one step ahead of these hackers?
No, that's a extremely important point for companies like us. We need to educate our, each one of our team members to the importance of acts of this nature. And that is exactly what we do. Not that we have started doing it after the Act. Even before the Act, from day one, we have made sure that our teams understand the importance of protection of data. And in fact, there is a reasonable amount of documentation is in place, which helps them understand their responsibilities. Non-disclosure agreements, which are at a much higher level, that ensure that our customers' data ideally is not seen only, and if they do get to see, then they don't talk about it. They understand that this is something that our customers are handing over to us in a custody, and we are responsible about that data as custodians.
What are some of the biggest innovations you're seeing on that front to solve for this problem of, data hacks and, cybersecurity breaches?
Sorry, I missed it.
What are the biggest innovations you're seeing in this front when it comes to the issue of cybersecurity?
No, there are, innovations on an ongoing basis on cybersecurity front as well. I think one of the ultimate innovation that we are going to experience maybe 3 years, 5 years, at the most 10 years down the line is quantum computing, which is where, the cyber encryption will be so difficult that it will be impossible for anyone to break that. But in the meanwhile, the encryption keys are increasing, the sizes of encryption keys are increasing. They continue to make sure that your ability to break the key is absolutely minimal. And that's how you try and secure the data. Of course, the misusers of technology would always want to be ahead of
well,
users.
you know what they say, no matter how much you invest in technology, your resilience is only as strong as the weakest link in the chain, which is the customer. I give off my OTP and all your systems are going to come to naught. But, you know, the other big buzzword that's really been dominating headlines when we talk about especially fintechs and, you know, technology in lending is that three-letter word, the new UPI, which is Unified Lending Interface. Just help us understand briefly, you know, how will technology help better and faster access to credit to the underserved, to the small borrowers, especially in rural parts of India?
That's a extremely powerful point, I think, that we have as an economy arrived at. Today we are talking about close to billion transactions per day. Given 2 to 3 years, we'll reach that number. That is 100 crore transactions in a day. And we are looking at, let's say, 10 crore micro, nano, small and medium enterprises. So we are looking at 10 transactions per day or 300 transactions per month, which are digital. And if this number is, let's say, 25% or 50% of the overall number of transactions, then what we are doing is getting a feel of that, you know, of that business through these transactions. And without this nano enterprise or micro enterprise being required to even think of a P&L and a balance sheet, as a banker, in a smart manner, you would be able to make out that over these 300 transactions that happened in a month, and if this is 25% of the business, then 1,200 transactions of, let's say, on an average 20 rupees each have taken place. So that means, and on an average 24,000 worth of revenue this nano enterprise has generated in a month. And if we are looking at 10% profitability, then we are looking at a profit of 2,400 rupees. Okay. And that is the profit that you will be able to see. And when you see that pattern for a 3 months, 6 months period, then you will be able to, as a banker, you might be able to say that, okay, I do want to take some risk and maybe make a 10,000 rupee loan available. And that too, without any paperwork. You know, I'll just say that, okay, I'm going to charge, let's say, 30% rate of interest because I'm taking higher risk. Yeah. So with that kind of interest rate, I'll be able to make that loan. I'll make a beginning on this business model, and over a period, this is through machine learning, through artificial intelligence, I'll be able to learn better and better business. I'll be able to create better and better business models, and finally, hopefully, we would be able to release the nano enterprises out of the 365% rate of interest that they pay today.
Well, that is the hope, and to serve the underserved segment, and for ULI to be for what UPI has been for payments, for lending. But on that note, on that optimistic note, Mr. Desai, thank you very much for your time here. Pleasure speaking with you. Thank you.
Thank you. Thank you so much.
Thank you, Ritu and Mr. Vishnu, for that engaging chat. And now, ladies and gentlemen, we have the final panel discussion for the day on the topic Fintech Race for Bharat. As India's financial landscape evolves, a new race is emerging, one that seeks to bridge the gap between traditional banking and the underserved regions of Bharat. And this race isn't just about technological innovation, it's about crafting solutions that resonate with the diverse needs of a vast population. and to understand how fintech companies are navigating the unique challenges and opportunities presented by Bharat's diverse market, I would request Ritu to kindly come back on stage to moderate the session. May I also invite the panelists on stage, Srinivasu MN, co-founder BillDesk, Lizzie Chapman, co-founder Swiffy Labs, Shinjini Kumar, co-founder Salt. I believe she'll be joining us shortly. Anand Kumar Bajaj, founder, MD and CEO Pay Nearby. Shinjini, welcome. And Kunal Shah, founder of Cred. Ritu, over to you.
Well, the topic for our discussion today, the fintech race for Bharat, it's not just a fancy trend. It's a theme that's really redefining the financial landscape in India, particularly that very vast rural and semi-urban market that we collectively refer to as Bharat. More than 65% of India's population resides in these non-urban areas. And so Bharat really represents that massive opportunity for fintech companies to really exploit. But catering to this diverse and largely underbanked population, it comes with its own set of challenges and, of course, opportunity. So today we have this exceptional panel that's here with us to help us understand, what kind of innovations you all are driving, to reach this rather underbanked or unserved segment of the society. Anand, if I would start by asking you to just differentiate for us, finance is finance, right? How do the needs of Bharat differ from the needs of India, and how are you as a fintech helping bridge that gap?
Finance is a finance, but sachet is a sachet. So what you can consume in 100 ml, probably a 20 ml or 10 ml is relevant. What you and I take it for granted on digital is actually not even a dream there. So the digital divide is only increasing with the digitization in India, leaving behind Bharat. So that is where we are starting actually to bridge the digital divide between rural, urban, Bharat, India. And there is lot to do, lot to do.
Well, Shinjini, to just take that forward, this digital divide between the haves or have too much and the have-nots, especially when you look at the underbanked segments of society, there are certain marginalized sections that would not even have the access to a smartphone or the technology to undertake this digital transformation. How do you specifically, using technology, are able to cater products for this segment?
A couple of things. One is exclusion is not necessarily always on the lines of poor versus rich. Exclusions cut across societal strata. And one of the things I have learned, with a lot of humility, I have to say this, after 30 years in mainstream banking, when I decided to get into building a startup and I decided to choose to focus on women, I kind of took it for granted that if the women have smartphones and if they're shopping on if they are on social media, they're shopping, they have education, because India is one of the countries which has some of the highest levels of education for its women, and a lot of work has been done in that space. So just galvanizing that availability of all of this infrastructure and putting finance on top of it, like Anand says, sachet can just reach anywhere. I think I differ in that, because productizing for excluded categories is not as easy as taking a product and changing its size or packaging. It is a lot more work to actually understand friction and that user's psychology in the case of not just gender, but in many ways. And because I've just come from my village after 2 weeks of very, first of all, heat, but various other things. And the kind of things I've learned are just unbelievable. I mean, I met a girl who's been saving in LIC, which is one disease that this country has. Just doing it for 10 years, and now finally realizes that she may not be able to get any of that money back because her maiden name is completely different from her name after marriage. And when Aadhaar gets made, then she gets a different name and a different date of birth. and then the money that she has been depositing all along, because there is an agent in between who's been taking that money has been deposited, and now her account is frozen and she can't possibly get that money back. It's her life saving. And that's not the kind of problem you can solve by size or packaging. So I'll just start from there and we'll go through it.
Well, Lizzie, if you take that forward, I mean, you know, pink products, sachetization, is that going to solve the problem for half the population of the country?
No, Shinji's completely right. If I'm honest, I think actually the fintech universe has a little bad scorecard when it looks at how we have solved this problem. If we leave aside UPI, because I think we can all evangelize UPI all day long, if we leave aside what we've seen in payments in the last 10 years, outside of that, fintech as a category has been quite poor at solving these fundamental problems of how we distribute these products. So in our new avatar, which is a company called Swiffy Labs, we actually partnered with Geo because we said, who is it in this country who understands scale, who understands distribution, who understands, you know, efficiency at scale and high throughput, and how can we use those rails and that type of technology to finally crack some of these distribution challenges that we're talking about. And what we're doing is working with the banks and building core infrastructure, because what we realized is that we need banks to be at the table for fintech to work, and we need infrastructure that can actually genuinely power these new products that we're all imagining and devising. It's no good to stick a layer on top and create a nice app and a nice website if the fundamental underlying technology has not been designed in a way that can handle, you know, 102 rupee transactions per day.
Well, often the reason we hear from larger players for, you know, not being able to serve some of these marginalized communities, the, you know, the very last mile customers, because it doesn't make economic sense. Is technology bridging that gap? Especially, you know, DPI has been touted as this game changer. Yes. Account aggregator is something that's not probably picked up much. Yes. ULI still in the works. You know, ONDC starting with financial services. UPI perhaps has been the only star.
That's exactly it, the acronym game. It's fun, isn't it? So we love all these new developments. We get to do these wonderful MOUs and presentations at GFF, and it's very, very exciting. But how many banks are actually using these to the full capacity? That's the question. And that's where we have to do the hard work. There's a lot of work to be done. The core banking systems of most banks in this country were not designed to imagine something like account aggregator. It's absolutely unfeasible to imagine pinging a ledger, you know, thousands of times a day. That wasn't envisaged 30 years ago. So it's actually up to us to work together to build the technology that can make these visions a reality, because we really do have some of the best digital public infrastructure in the world, but we're not utilizing it to the full capacity because we're not investing in the technology bridges that Anand mentioned.
Well, then, you know, let me ask the two gentlemen there in payments. You know, the next layer of credit unlocking, really, you know, for the ecosystem. While you're not doing, you know, you're more focused on payments, but let me still ask you as an industry player, this buzzword I'm sure you've heard across the 3 days at the Global FinTech Festival has been unified lending interface. Just help us understand again, I mean, is this going to be the game changer that we've all been waiting for to get to that last mile customer and to not just over leverage, you know, just the urban customer?
I'll go at it first so that I can react to what you say.
No. Kunal, if you'd like to take it, and then maybe Srinivasu.
I think first of all, it's important to address a couple of points made earlier about understanding. We use the word digital divide but I think the interesting thing to see is that how many customers are on UPI and how many are not on UPI. It's an easy way to kind of split the country.
400 million unique users.
Yeah. Now, when we look at the exclusions, what Shinjini talked about, let's say we have children, women who are not actively participating. In India, we always divide these things of money transactions were done by the men in the family, and we also see this even in credit card bill payments. Women's credit card bills are actually paid by their husbands or their parents, and it's an interesting pattern that it's very deep in our society, right? So these are some other exclusions that we have, but the key point on understanding is that technology does not create a motivation. Technology fulfills a motivation. If you do not have enough money, you are worried about how do you live, survive, eat, versus, oh my God, how do I bank this more efficiently? So we need to understand that just by bringing the costs down, we have brought costs down to a level that is almost hard to sustain at. And the thing is that we have to understand that the user motivation needs to match, because we have probably got the cheapest data. We have access to all the smartphones in the world at all price ranges.
I was waiting for one of you to start telling us about those numbers. The number of mobile phones and the smartphones.
No,
that
I'm not. I think every data is out there. It's just that we often miss the point of consumers' motivation to do certain things. Telco did not need as much because people's need to connect with human beings was so deep that it just worked out in the smallest SIM cards here and there, and we've got so many people on it. So it's about matching the motivation versus trying to say that, hey, there is a fintech opportunity over here, and also sustainability of these customers. It's not that people are saying, oh, I don't want these customers. It's just that these customers are very hard to monetize, very hard to lend or collect from. And coming to the ULI question, it's too early to talk about. We have still to figure out what it is and what it's going to build. And I think it's every single thing digitally will become big. But the simplest idea I have, 99% of the country is on prepaid phone connection. For most developed countries, it would be less than 1%. If you can just give credit for talk time, we'll probably take the country forward in a different way.
Are those all the reasons why you choose to cater only to the 750 CIBIL score and above, the urban affluent customers, which the CA referred to as, the goose that keeps giving the golden egg? You're over-leveraging, overplaying that card.
No, it's just that there are just too many players serving the whole country. And
Too many players serving the whole country.
Especially the global companies who are actually quite good at doing that with their ability to deploy capital behind it. And I think for companies who are trying to live with investor capital who are expecting return, it's good to kind of make money and be profitable.
We'll get back to you in just a bit. But Srivasu, I believe you have a different view of how the whole unified lending interface may play out. Borrowers, sure, it may be good, but how does it affect your life?
I'm first going to react to a couple of the observations they made, including questioning whether there is a golden egg and whether people don't look at the bottom of the pyramid because it's not economically viable. I also believe
let me just put
top of the
context to
pyramid
that
itself
again.
is proving tough to be viable.
Okay, just a quick context to that, because we had Jairam Sridharam of Piramal Finance just tell us, 10% of all the digital borrowers at any point of time have 10 active credit lines. So that's the kind of over-leveraging we're talking about.
Absolutely. So I think to the theme of the discussion, right, I think one point I want to state, to the point Anand made, I think there is a need for a sachet. I agree with the points made. How you define the sachet and its delivery is going to be a huge differentiator. I used to work in FMCG earlier before starting here, and I can tell you this, one learning I took away from there, you cannot cater to Bharat sitting out of Mumbai, right? I think that's one learning of many years ago, and I think that's a point Shinji was trying also to make. We can talk all we want, Bharat doesn't get delivered from here. It's a whole new way of thinking culturally, ethos, organization, people. The cost structures and the price of delivery are economics. But what does that market need is not going to be solved here. That's one point. But to the two specific aspects around lending and payments, I do think the top end of the market itself is stressed. I mean, we've heard even the earlier panel speak, 8 crore tax-paying population trying to cater to 140. So anybody trying to serve India, it's a tough thing unless you find niches and you're kind of able to make your profit pool. Still, there's a discovery of that market. That's one part. To the construct of the need that there is a big need for lending, underserved markets and delivery. There is a view, one should question why the need for ULI, right? There are enough fintechs trying to do cater to that market. There have been account aggregators for nearly 5-6 years trying to bring data to the table that helps address the market. So one should look at why ULI, who thought of ULI, who pushed for ULI, how did ULI come about, what
Please answer all those questions for us.
No, I think that's, as Kunal pointed, those answers that will emerge over the period. But I think the need that was felt was a regulatory platform perhaps is going to help accelerate meeting the need, because there are multiple players trying to solve for different parts of the chain the way they define the problem. And as like Jairam pointed out in the earlier, or I think maybe it was Asim, who said it's the elephant in the room. Each one can have a different point of view. At this point, I think the regulator has a point of view that going from the success of UPI, if you create an interoperable standardized platform, maybe it will help accelerate something. There is always going to be a plus and a minus to what it will achieve, right?
Let me ask you to elaborate on that point about the account aggregator not picking up and why ULI will be any different.
I think, I mean, my view, I'm not involved with either of the businesses of account aggregator or ULI, let me stay there upfront, but I do think the account aggregator model, 5 or 6 or maybe 7, 8 private companies trying to aggregate data from large regulated entities is not something that's taken off smoothly or in quick time. The need for that is there, right? And most fintechs have gone back to regulator and other policy makers stressing the need for availability of data from incumbent large players for them to build their business. So obviously if a regulator or policy maker keeps getting input 50 times a day from 50 different people, they think there is a need, and then they look at a market which says it's not delivering. Maybe there's a need for intervention to create a standardized platform, and that's where we are today. And so hopefully that plays out well.
Well, hopefully that does play out well. Anand, I wonder if you share the view.
See, I totally agree. And I would tell you that I was just asking Shinjani, the ULI sounds like a BBPS moment to you, Vasu? Everyone having billers connected directly to you, and then suddenly the regulator comes with a BBPS. So whatever is playing well in the industry, boys, get aside, I will do it now.
It could well also be a UPI moment, so.
There you are.
Oh. Okay, sorry, finish your point here.
No, so the point that I was making is, see, the regulator is putting guardrails. Before that, it allowed lot of experiments to happen. Lot of that has been incorporated in the guardrails. There are certain customer-friendly measures that the regulator wants before the scale to happen. We say stability before scale. Automate or eliminate, because unless you automate, you can't scale. But before scaling is a responsibility in any sector. And before you scale, you have to stabilize the things. Before stabilizing, you do all your experiments. So here is a regulator, here is the government wanting a lot of things to be experimented. The angel tax has been waived, more and more encouragement for the startups to receive that fund so that more experiments are done. But after that Samudra Manthan, there will be a wish coming out, and then there will be Amrit coming out. So I think we all have to go through that grind. Liz, I don't know the poison and the nectar that if you have heard the story, but that's the whole idea. And every evolution, Kunal, and you said it well in a podcast, that a monorail mode like a religion will scale faster, but it is very fragile. One flick and the whole thing collapses. Fintechs are in a similar way. Unless you are centipede and doing 10 things, you would be dead twice or 10 times already. And look at just a while ago, not in India, in Bharat, where things are not viable, in isolation. Here we stood as nearby technologies saying, Har Dukan Digital Pradhan. The retailer is the harbinger of digitization for the nation, for the upliftment, and we took multi-modular architecture through them to the Bharat. What we did was build a railroad and then put a Malgadi, Sawari Gadi and Rajdhani now running on it. Every transaction is viable. So instead of burning lot of investor capital and then not being able to make money, before you start making money, there is someone else who comes and burns money. We chose a path of earn and burn. So every transaction is unit economics positive, and I think it's another way of doing things if you don't raise capital. Or sorry, can't raise capital. Kunal, that's a better way to say.
Well, yes, Shinji.
So after 3 days at the GFF, and all these questions around ULI versus OCIN versus ONDC, I was reflecting and I was thinking, this is like, Jaki rahi bhavna jaisi hari murat dekhi tin taisi. So credit is one thing which in financial services, from the beginning of my career, I have seen that everyone goes into into a lot of excitement about credit, because after all, it is a very high profit product, right? But at the end of it, the success of your credit product depends on very few things, which is something that Kunal said earlier. There is a customer there and they have a real financial life, and their financial life is going to determine what product they're going to be able to use, what return they're going to give you, whether they're going to be profitable, etc., etc. Now, while regulators, just one thing on your ULI thing, and I really do think that the way credit is done needs to change in a country like India, which has a massive amount of poor people who don't have assets, a lot of women that don't have assets in their names. So I am very much for innovation that supports data, that supports personal data use, etc. But believe me, that is not going to happen in this way, because if priority sector lending had actually happened the way governments and RBI wanted, then we would never have needed any other intervention. So it's not your intent to say that I'm going to take this data and I'm going to put this data together and I'm going to build this platform and everybody is going to start lending on it. You have to realize that in the same market, you have different types of capital. At the end of the day, you are what capital supports you. So you have, global capital that Kunal talked about coming and, spreading it and telling, oh, everybody who has a SIM card and a prepaid gets a credit line. Then you have somebody else coming in and saying, okay, everybody who has a certain type of debt. But unsecured lending, boss, it is such a easy thing to do that you compare that, and all you have to do is to keep increasing your interest parameter. You can take any amount of losses. You can play that game for as long as the economy doesn't really tank and liquidity is available to you. You compare that to building this very sophisticated, very hardworking thing. The nature of capital that needs to support it needs to be really long-term capital. Somebody needs to say, I'm going to allow 3 years or 5 years of credit cycles to come and to create this platform. I mean, it took so much time for CIBIL to stabilize. We've all seen in our lives, right? You can't, these things don't happen like this. Oh, I inaugurated something, I did a pile, now this is the next
patient investors and patient capital. Yes. Yeah, well, let me put the other two sort of new buzzwords, and Kunal, your word on this as well. A credit line on UPI. It started off in a small way. It's only linked to RuPay cards. It's only being done with some banks. But you have 60 million credit card users maybe in the country. You have 400 million UPI users. Put that together, and what does that give you in terms of solving for Bharat?
You missed an important data point, how many income taxpayers in the country as well, which is a very important factor to determine who can be given credit or not given credit. We cannot short-circuit these paths by just collecting numbers. Lending requires stability of income, because lending businesses work when you can collect and provide consistent returns to people who have given deposits to you. So for a bank, it's not that they are not seeing this. They would love to expand the base. Even the 60 million number, I think one would argue is probably a much aggressive number than what it should be, and we have to still see a cycle. When we started CRED, we had close to 18 million customers, right? So in 6 years, we've already kind of tripled this number, and we have to see the cycle first, right? So I think a lot of times, any aggression on everything to do with credit comes with a lot of bad news, and it's happened multiple cycles, and we have to understand and appreciate that. But we have to truly know that unless there is consistency and stability of income, it is unlikely to happen. Doesn't matter you do RuPay, credit line, you can keep naming products differently, the principles of lending don't change.
Lizzie, would you do?
No, exactly, and I think it's actually very similar to the same point on ULI, ONDC. Ultimately these are credit enablement platforms, right? UPI credit line is really just another form of enabling credit to be distributed more easily. What it's not doing is providing differentiated underwriting, differentiated operational infrastructure, differentiated collections infrastructure. That's not possible with these platforms. So I think we've got to stop saying, this is the UPI moment for credit. That's a completely irrational statement, and it would be frankly unhealthy if we were to look at credit like that. Credit is ultimately the distribution and pricing of risk, and we need to understand what does risk mean. And actually what nobody talks about is how we think of different ways of packaging and parceling risk in a healthy, developed capital markets. So just putting another layer on top and bringing everybody to the party without understanding that there has to be this back-end marketplace of risk is not going to solve the problem of financial inclusion.
Well, Srinivas, I'm going to let you have the final word before we wrap this on what, to your mind, will truly move the needle. When we talk about solving for Bharat and bringing in inclusivity, also profitability for players, because it must make economic sense for you to continue to innovate and expand. I mean, in the case of payment, the payment ecosystem, the MDR, of course, has been a thorny issue. Are those kind of issues deterrents to innovation?
As to what it takes to cater to Bharat, I think that whatever Shinjini and Lizzie have articulated, I think at first level it needs patience. In whatever you do, it needs patience. That means in every sense. Patience in terms of the enterprise's outlook, the capital backing it, to the way policy thinks of it, right? To the point she made, creation of a platform itself doesn't result in an explosive growth unless it's, other factors come together. There is enabling infrastructure getting created. I think the one important takeaway from there perhaps is that there's been a very vibrant fintech sector over the last 4 or 5 years. There has been a lot of knowledge that they've brought to the table, and I think these knowledge inputs have helped the policymakers and the regulators create the enabling framework and the guardrails, right? One impact out of that is typically it's going to be whether intended or unintended is simply this, that it's going to commoditize a lot of things. Figuring out how to differentiate, to the point that she made, is going to be the key factor. At what cost do you build the differentiation? Will it play off is the other factor. There'll clearly be global players who kind of play two segments of markets, saying loss leaders versus profit markets, all that will happen. But what does it take to do? I think just patience and long-term outlook is about a key ingredient needed. Models will change, models will evolve, people will learn, regulator will learn, guardrails will change. I do think with some of these things, banks backed by good technology for fintech platforms have a better chance of succeeding in the coming years than they had, let's say, 3 years ago.
Well, on that wonderful note, I mean, clearly the takeaway is you're in it for the long run and you need a lot of patience. There's no overnight solutions for solving for Bharat. On that note, all of you, thank you very much, ladies and gentlemen, for candidly answering all of our questions and for your time here. Thank you very much.
Thank you so much, Ritu, and thank you, panelists, for closing the day with such an informative discussion. Ladies and gentlemen, a huge round of applause for our panelists here. I would now request Mr. Parag Bhise, the CEO of Nucleus Software, to kindly come up on stage to deliver the closing address. Welcome.
Thank you very much. Dear esteemed industry leaders, partners, and colleagues, on behalf of Nucleus Software, I would like to express my sincere gratitude and appreciation for your invaluable participation in the Banking Transformation Summit, Season 2, centered on Bharat's banking roadmap for the future. We are grateful to Mr. G. Swaminathan, Deputy Governor of the Reserve Bank of India, for sharing his insightful thoughts on India's evolving banking landscape, getting ready for the $10 trillion economy. His discussion illuminated the exciting opportunities and challenges that lie ahead. Similarly, I would like to extend a special vote of thanks to Dr. V. Ananta Nageswaran, CEA, to the Government of India for his inspirational insights on where the Indian economy is headed, as well as on building momentum for India's banking to be future ready. His compelling vision has provided significant direction for our collective future. The panel discussion, Filling the Credit Gap to Fuel Economic Growth, and Vishnu's session on transforming to new age digital lending were pivotal in highlighting the collaborative efforts essential for driving meaningful progress. These conversations underscored the dynamic interplay between technological innovation and regulatory advancement in our rapidly evolving financial ecosystem. Similarly, the fireside chats with Mr. Khera and Mr. Srinivasan were very insightful. That our finest leaders, banking leaders, are not ready to hang their boot yet was truly inspirational. As we navigate this era of digital transformation, events like these are crucial for fostering dialogue and forging partnerships that drive forward-thinking solutions. The discussions on smart lending in the era of tightened norms and the Fintech race for Bharat showcase the resilience and adaptability within our sectors, reflecting our collective commitment to the innovation and progress. Finally, a special thank you to our partners, CNBC-TV18. Your support and collaboration were instrumental in making the summit a great success. At Nucleus Software, our 38 years legacy of excellence and innovation in financial technology reflects our dedication to shaping the future of banking. We remain steadfast in our mission to lead this transformation by developing solutions that address today's challenges and anticipate tomorrow's needs. By empowering our partners and clients with advanced tools and technologies, we are building a more inclusive, resilient, and future-ready financial system. I would like to extend my heartfelt gratitude to all stakeholders who are tirelessly working to construct a forward-looking banking and financial sector landscape. Your insights, innovation, and dedication make these discussions both impactful and inspiring. Thank you once again for your active involvement and unwavering support. Together, we will continue to shape the future of banking in India and beyond. Thank you so much.
Thank you so much, sir. Well, that brings a close to the second edition of Nucleus Software presents CNBC-TV18 Banking Transformation Summit. I would like to thank Nucleus Software for making this summit a successful one. A big thank you to each one of you for being such a wonderful audience. Please join us for cocktail and dinner.